Good morning. Hopefully you can hear me. Thank you for attending our fourth annual conference in aid of the Alzheimer's Association. Sorry we're a bit late this morning. Had a few technical difficulties. This is as new as it is to me as it probably is to you. So sorry for that. But I just want to thank you for all your donations. In a time when, you know, in strange times where we're experiencing much about noise about COVID and related deaths and things like that, which is terrible. Other diseases seem to be forgotten, and Alzheimer's is a disease that is close to my heart, as I know it is a lot of yours and your loved ones, and it affects 1 in 10 Americans, and 5 million Americans are living with the disease, and it's estimated that at least 500,000 deaths annually are due to Alzheimer's. So I really want to thank you for your donations again. I appreciate it. You know, we've got a great conference today. I'm praying there's not many more hiccups like we just had, you know, we're just adjusting to the new way of doing things. So today we have a magical lineup of professionals, loads of idea generation and different thinking. We'll be finishing with some time with a panel, including myself, who will answer your questions. Questions can be put in your boxes, and Paul Johnson, who some of you might have seen before our New York conferences, fantastic speaker, will moderate those questions and the questions to the panel. Just make it clear who they're aimed at and the description of your question, please. And we'll endeavour to answer as many as we can. So I trust you enjoy the show. I'll hand over Paul shortly. But before that, I just wanted to show you a short video just to increase your education and understanding of people with Alzheimer's. It's very important that you know, we don't lose sight of why we're doing this conference. 100% of your donation goes to the charity by the small Eventbrite fee. We've raised over $6,000 today, which is fantastic. I'm so proud. You know, so I'm going to show you this video. Just take 3 minutes of your time before we start, and hopefully it's just going to increase your knowledge about the disease and what you've actually donated to, if you weren't so aware. So I appreciate that. I'll be on a little bit later. Watch this short video, and look forward to seeing you later, and hope you enjoy the conference today. Thank you.
Alzheimer's disease. Alzheimer's is a slow, fatal disease of the brain affecting 1 in 10 people over the age of 65. No one is immune. The disease comes on gradually as 2 abnormal protein fragments called plaques and tangles accumulate in the brain and kill brain cells. They start here in the hippocampus, the part of the brain where memories are first formed. Over many years' time, the plaques and tangles slowly destroy the hippocampus, and it becomes harder and harder to form new memories. Simple recollections from a few hours or days ago that the rest of us might take for granted are just not there. After that, more plaques and tangles spread into different regions of the brain, killing cells and compromising function wherever they go. This spreading around is what causes the different stages of Alzheimer's. From the hippocampus, the disease spreads here to the region of the brain where language is processed. When that happens, it gets tougher and tougher to find the right word. Next, the disease creeps toward the front of the brain, where logical thought takes place. Very gradually, a person begins to lose the ability to solve problems, grasp concepts, and make plans. Next, the plaques and tangles invade the part of the brain where emotions are regulated. When this happens, the patient gradually loses control over moods and feelings. After that, the disease moves to where the brain makes sense of things it sees, hears, and smells. In this stage, Alzheimer's wreaks havoc on a person's senses and can spark hallucinations. Eventually, the plaques and tangles erase a person's oldest and most precious memories which are stored here in the back of the brain. Near the end, the disease compromises a person's balance and coordination. And in the very last stage, it destroys the part of the brain that regulates breathing and the heart. The progression from mild forgetting to death is slow and steady and takes place over an average of 8 to 10 years. It is relentless and, for now, incurable. Helping your family, friends, and neighbors to better understand Alzheimer's will reduce stigma, improve care, and even help the fight for a cure. Thanks for helping to do your part. Learn more at www.aboutalz.org.
Okay, great. So Paul, I'm going to hand over to Paul Johnson. Now, Paul Johnson is professor at Columbia University, also runs his own investment firm, participated in all our previous conferences, actually. I know you're going to enjoy him. He's got a superb presentation, actually. So I'm going to hand over to him now, and I'll leave it up to him, and let's get on. Thanks, Paul.
Thanks, Jim. I appreciate the introduction. No, it's been great to be involved. And look at that. It looks like I've got my screen shared. All right. Welcome to everybody that attended. And I echo Jim's comments. Everybody that donated to Alzheimer's, we're all getting older. So we're pre-funding our own medication. This is a new presentation I've been developing this summer, which I call the value of growth. I think the challenge we all face is this. We have Apple, Amazon, Microsoft, Google, Facebook, there's others, but that have these market caps, numbers we've never had to deal with before, trillions, and in Apple's case, maybe even 2 trillion. And so the question, of course, is is there a way to think about these market capitalizations? What are investor expectations? Is there a way to wrap your head around it other than sort of the narratives we hear about Apple becoming a service company and Amazon become the largest company ever? Those narratives don't do much for me as an investor. So I try to develop some tools, which I'm going to share with you on a way to think about these market caps in a new way. There's some visualizations, which I think help capture it. So let me walk you through that. All right. First and foremost, I come from the old school where the value of any asset is the present value of its future cash flows, discounted back for time and uncertainty. DCF, generally referred to, discounted cash flow model. I'm sure some of you have already perhaps starting to roll your eyes, but if you bear with me, this will lead our way in, I think, to give us some insights. I think the most important aspect that we've learned about a DCF is that it doesn't do very well as a valuation metric, too many assumptions, too sensitive to the assumption. But if you tease it out, the real challenge of a DCF is growth. And I want to give you some tools that potentially leverage the goodness, the good parts of a DCF, but give us some more insights. All right. I'm just gonna give you a quick definition of free cash flow that I use in the model. It's basically net income where we replace maintenance CapEx with depreciation. So this is a no growth cash flow, very important. And if you don't have growth, you don't have to worry about working capital or changes in working capital. So this is essentially a steady state, no growth level of cash flow for a company. And if you assume no growth, the nice part about a DCF is that it collapses down to an incredibly simple model. So if we assume no PAT in year 1 is equal to no PAT in year 2, no PAT in year 3, no PAT all the way out, we then get this fantastic formula, which is a perpetuity valuation formula. Now, by definition, we are now valuing a company without growth. So we've got to come back and look at growth in some ways, and that's what I want to do. But I just wanted to see if we could come up with the value of a company without the growth, since growth is the challenge. All right, so the no growth steady state value is defined as no PAT divided by I. We're using the perpetuity formula, and we define that as the earnings power of value. So we've tied this back to very classical value investing. So that's your earnings power value. All right, enterprise value, which we all know is the market value of equity plus market value of debt minus excess cash plus some other things. I'm going to keep it simple. The market value of equity is investors essentially how they value the equity of the business. Market value of debt, we often use book value as a proxy because we can't always get market value of debt, particularly if it's private debt or bank debt. And then excess cash, which is always a little tricky because I don't know how much that is. But we do know that enterprise value, the definition, and that is essentially the value of all cash flows. I think this is really important to keep in mind, is the enterprise value is essentially the market's estimate of all cash flows at that company. All right, if we then take earnings power value as we just defined, as we just defined it, which is NOPAT divided by I, which is your steady state, no growth value of cash flows. Then if we subtract off the earnings power from the enterprise value, you clearly get, sorry, that's your steady state, no growth in cash flows. If you subtract off earnings power value from enterprise value, you get the market implied value of growth in cash flows, which is investors' expectation for growth in cash flows. So this for me is kind of come together over the last couple of years, this realization that we can actually tease out investor expectation for growth in cash flows, which is, I think, incredibly powerful. And that was really got me started this summer on thinking about how in the world can we use this tool in a way to get insights into what investor expectations are, particularly around growth. All right, so just as a quick reference, because I'm going to do 3 case studies. Reference number 1 is the just as a reference, S&P 500. You can just look at the market implied value growth for the S&P 500. Their 10-year average is 35%. The 5-year average is 40%. So I just want to give you that as a reference point as you go through it. All right, let's look at Apple. All right, here's Apple's enterprise value over the last, I guess that's 7 years. The LTM is the most current one, priced as of yesterday. So it has a $2 trillion market cap, up from 1.3, enterprise value, up from 1.3, up from 930. This has been a monster stock. It's doubled, more than doubled in the last 18 months, which is very impressive. Great performance. Now, where did that value come from? All right, so there's your earnings power value for Apple for the last 7 years. It has not really budged much. So in 18, it was 723 billion. Now it's $700 billion. Not trying to imply precision. So it really hasn't moved much in the last couple of years, although as we saw, the enterprise value has more than doubled. So where does that come from? The market implied value of growth is the key. And you can see, I'm just going to isolate that. So there's your market implied value of growth. So at the end of 18, it was $200 billion. That's what investors were paying for the growth in the cash flows at Apple. And today, investors are paying $1.35 trillion just for the growth in cash flow. So the dramatic increase in Apple's valuation, which we've seen here, more than a double, has come exclusively from investors' expectations for future growth. And if you look at it this way, this is a percent. So this is market implied value of growth as a percent of the enterprise value. It's now up to 66%. It's the highest it's been in the last decade. So just keep that in mind. We'll talk a little bit about growth at the end. I just want to run through these case studies. All right, Microsoft. There's Microsoft's enterprise value. It has also gone up almost threefold in the last, since the end of 17. This again, their valuation as of yesterday, which is pretty impressive. You could see that their earnings power value has gone up a bit. Sorry, you can't see the numbers. Sorry about that. It's gone from 311 to 483, so it's up about 40%. Well, the overall valuations has increased dramatically more. We can see that the market implied value of growth in this is in percentage. Sorry, the title is wrong. You can now see it's at 70.1%. You saw that in Apple. You can look across. You can see that it's at the higher range than it's had, but by historical standards, the percentage is not way out of bounds. Fairly dramatic increase in profitability after new management took over a few years ago. Let's look at Google. All right, there's Google's enterprise value, just shy of 900 billion. It's up maybe 50% over the last 3 or 4 years, not as dramatic as the other two. You can see that the enterprise value has been fairly steady the last 2 years, but up fairly significantly from the years before that. And then if you look at the market implied value of NOPAT growth, you can see it's right around 55%, which is very much in line with its historical average in the last 6 years, which is important. All right, Amazon, my favorite one to talk about. There's Amazon's enterprise value, just shy of $1.6 trillion. It up, 2.5 times in the last 2 years. There's their earnings power value, sort of significantly lower than anybody else's. I know we hear all the stories that they're not showing their earnings power. They're really focused on growth. Investors get that. There's your market implied value of NOPAT growth. It's more than doubled in the last 2 years. So investors are willing to pay dramatically more for the growth than they were before, which is important. However, if you look at it as a percent of enterprise value, it's really been the steady state for 6 years. So Amazon is no more expensive today than it ever has been. And despite, a lot of people think that the stock has gotten ahead of itself, certainly on a historical basis, it's at the lower end of its range by historical, as the market implied value of growth as a percentage. So just point that out. All right. Kind of interesting. I took Amazon and just compared it to other large retailers. I know Amazon's not really a retail company. I'm told that all the time. So this is not a great comparison, but you just give you a reference point that if investors ever thought that it was a retailer, this might be the comp group. And you can see that all of them have expanded, or I'm sorry, the two big, Walmart and Costco, have also expanded their market implied value growth over the last few years. Part of that is driven by rates for sure, but part of that is both Walmart and Costco have actually executed pretty well. Target, which is interesting, trades at a significant discount, and then Best Buy discount to even that. All right, so let me talk about growth a little bit. I lean on the work of Everett Rogers. 1962, he put together this technology adoption life cycle, which he categorized as we have innovator, early adopters, and early majority. The key is the early majority. That's where your big market is. That's where your growth comes from. And if you look at a cumulative market, you get a nice sigmoid. That's the S curve, the blue line. If we map the cohorts of buyers onto the sigmoid, we can see that as you get to the early majority, that's the vast majority of your market opportunity. All right, in 1991, a good friend of mine named Jeff Moore said that the problem with Everett's model is that early adopters and early majority are not the same. They don't lean on each other. Early majority only works, the early majority only adopt your product when they start to adopt your product. But so you have to cross this chasm as he defined it, and you get to the early majority. The nice part is that once you get into the early majority, you move into something called hypergrowth. And so all of these companies, the first case studies we're looking at are companies that are growing very fast. I call that hypergrowth. It's growth that's going to last for a while, maybe a decade, maybe longer, but it's unsustainable over the life of the company, obviously. But when they're in that high growth market, it's growth, and more growth is what matters. All right. So once you've crossed the chasm, these are your investment rules. Only growth matters. Profitability almost always expands in the tornado. Most of these businesses are scale businesses, so you get winner take most in many of these businesses. It may take many years to unfold, and valuation does not matter. And I think that's really important to keep in mind in these growth times. However, once you get to the saturation point, you move into the late majority, which again can take a long time. I'm not suggesting this happens quickly. You then have a different set of investment rules. Growth decelerates, competitive pressures return, traditional competitive advantages are tested, right? That's for the first time. That too may take years to unfold, and valuation really matters. In fact, it matters more than ever before. So I think that's really important is that you take away from growth is only growth matters when you're in the high growth market. Valuation does not matter. And as you saw in all of the cases, investors, particularly in this environment, are willing to pay a very large percentage of their enterprise value for that growth. However, if you ever get to the point where the deceleration returns, you've saturated the market, you've saturated the early majority, you're moving into the later stages of the market, your growth will decelerate, competitive pressures will return, and valuation will matter. So the key takeaway in my mind, investing in these companies, is as long as growth is the driving factor, valuation will not matter. And we see that in the visuals I did before. All right, so I ran through that very quickly. I know I suspect we have time for Q&A if we do it, but Jim, help you get back on schedule.
Absolutely, Paul, and thank you for that. So super interesting. So we'll keep moving here. I want to move on to something a little bit more factual now. We've been working with KPMG for a while. We've got Bill Steciak. He's a managing director at KPMG in the carve-out process that they run around there. Responsible for talking head-on with companies actually about their plans, and it's super interesting at the moment because we've been discussing where the companies go at the moment. I mean, there's a lot of disconnect between what they were making before and the impact of the pandemic, and how they're going to come out the other end, and should they change now, and maybe they shouldn't, maybe they should. So there's a lot of stuff going on. But what we've collaborated with KPMG at the moment is a joint study, and that joint study looks at the effect of carve-outs and IPOs and things like that, just to really hone down on the factual numbers, really, that make sense. Now, if you recall, we carried out a similar study with Deloitte some years ago as well, and it really forms the basis of a lot of our analysis, really. I mean, people know me say, well, Jimmy doesn't rely too much on the facts, goes a little bit with what he feels and what he thinks the future could be. And yeah, look, that's true. But, at the end of the day, got to rely on solid numbers and the facts as well. So this is what we've done with KPMG. We're quite excited really to present it first here. It's just been released, and Bill's going to present this. And so I'm going to hand over to Bill and take what you can from this, because it's super interesting.
Yeah, I'll talk a bit about it. Jim, thanks a lot. We were really excited to team with The Edge on this paper. Ralf Pfennig, out of our Germany office here, is going to take the lead on covering the first few pages of the analysis, and I'll cover the back half. But it was a great study of over 45 companies that have spun or did an IPO or some type of carve-out transaction over the course of the last 5 years. So Ralf, I'll let you kind of lead us in, and I'll take the second half. You're on mute, Ralf.
Sorry. Thanks, Bill. Can you hear me? Because I had some problems with the line. Is it okay?
Yep.
Great. So before we start, I would like to share my screen with you. 1 second. We put together some slides. Can you see my screen?
Yeah, it's up, Ralf.
Okay, great. So as Jim and Bill mentioned, we have put together a very nice paper regarding carve-out transactions, and at least here in Germany, this is a very relevant issue because we had the carve-out of the Siemens energy business some few days ago. We saw within Corona that, of course, some of the companies have to more focus on their core business, and for a lot of them, carving out a part of the group, carving out a part of the corporate structure is really an option to focus on key business and to also make money and divest to get more cash flow. So what we did was an analysis based on specific measures that relates to carve out. We started this analysis a half year ago because a lot of our clients nearly had the same questions. For example, how long does such a transaction take us? What are the key elements in which companies are going to run with so-called TSAs with the former parent company? What is a classical leverage ratio, etc., for the carve-out business? And that was the reason why we started an analysis of the carve-outs which happened at the capital market. And maybe before we jump into some details, we are very happy to provide you with the first insights of these results. The whole paper has been published yesterday on our website, and we are today more than happy to provide you with some first results from from our white paper work, which we put together with Bill and myself, and also Jim from The Edge. As I mentioned earlier, one trigger is, of course, COVID-19, because carving out a specific business area will be an important part of the future business strategy in order to focus on specific areas of the company. And of course, in serious times, this is also a strategy to come to more cash flow and to divest some part of the company. What we did, we looked at 45 public capital markets carve-out around the world, with the focus in the US and in Europe, especially Germany, and analyzed some of the major features of those carve-out transactions. What you can see here on the slide is a briefly overview about the population that we had in the scope. As mentioned, the focus was on US. Of course, carve-out is very common in the US, but also in Europe. What is also very interesting, that there is not one sole branch or industry which is focusing on carve-outs. What you can see here on the slide is that there are a lot of branches which are dealing with carve-out. But of course, here's a slightly focus on financial services, because this is a highly regulated business model where some of the companies are trying to divest some of those areas. What we also saw, that there is some specific transaction types. Most of the transactions in our scope had been the form of a spin-off. Some others were real IPOs, where the business is offered to the public in order to make an initial public offering. And we had also some of the transactions which included both elements of an IPO and a spin-off. But I think that's not a real surprise, because especially in the US, the spin-off of a business is quite common. These are the 5, let's say, key insights which we would like to provide you with some more details during today's session. What we found out is, firstly, the share price of the carve-out business is developing favorable overall, as well as in the time frame. So in the period of time, the market price is increasing, but also in terms of specific comparison with peer groups, etc. Those carve-out business are regularly performing very, very well, which is supporting the idea of making carve-out to increase shareholder value. Second piece, which we found out, is that it really takes time to go through such a carve-out process, because the preparation for the company to be standalone, to be legally standalone, to be organizational standalone is really, really very complex. And we found out that this process normally takes the companies about 12 months to be prepared for such carve-outs. Of course, this is a really complex project with tax issues involved, with legal aspects involved, with accounting issues to be considered, with equity story aspect, etc., etc. Those transactions really need a PMO to manage, and it's also very complicated for those transactions in terms of what are the financials of these carve-out business, because normally they are part of a broader group, and it's not such easy to determine what is the financial statement of this carve-out business. So carve-out financial statements have to be prepared regularly, which is very often a time critical and also very complex exercise. And last but not least, before we jump into some charts of our analysis, we also had a look on the transitional service agreements, TSAs, where the carve-out business is using some of the measures of the mother company for a specific period in time, for example, legal services, accounting, etc. And we found out that it's a very common instrument to focus on the real business. And what you can see later is that there was a specific time frame where the carve-out business is using these TSAs, and there are also quite common areas for such TSAs, which are always in each of those cases in place. what we would like now to share with you is some more insight on these 5 topics here to give you some more guidance, especially in terms of the development of the share price, which we found out. And for that, I would now like to hand over to Bill.
Great, Ralf. Thank you. You know, as we look at the results of the 45 companies that we investigated here, one of the things that was very clear is that transactions that created a truly independent company yield a better result than transactions for which the parent still stayed involved. So if you're looking at doing an IPO of, say, just 20% of the business versus doing an IPO of 100% of the business, you know, the results for those companies that did a 100% of the business and pretty much gave control over to a new management team showed better, as you can see here in the study, you know, with regard to the 3-year performance metrics. Those that, the other part of the study that was interesting to us is that when you looked at the share price for the companies over a 3-year horizon or so, you tended to see that the share price in the first year you know, had some growth for many of the companies, but it wasn't until the second year where things really started to take off. And you know, as you think about that, that kind of makes sense. It takes a bit of time for the company to begin its march towards improvements and so forth under the new management regime, and you start seeing the real benefits of that, you know, kind of in that second year and continuing on into that third year. So strong correlation between transaction type and who controls, as well as you know, a strong correlation between when you start seeing the stock price really go above the indices and so forth, being more so in the second and third years. And as we evaluated the transactions, the IPO format tended to be a better performer within the population that was studied. Ralf, we can go to the next page, please. As you think about the time it takes and to pull form a carve out and separate your business, this is no short duration here. You know, as we looked at the companies that went through this process, there were a few, you know, about 9 or so that got done in 6 months, but the majority were 6+ months to complete this process. So key things for management to consider as you're going through this is that to give yourself time. You know, it's likely, and as we tell companies that are going through this process, usually 9 to 12 months is about the right time frame to get one of these transactions done, depending upon how integrated your business is. So the more integrated the carve-out entity is, the harder it is to pull it apart. Some of the key things that would help you to you know, potentially shorten the duration. So as you look at these companies that are 9, you know, the 9 or so that are at the 6-month time frame, it may be that you could start, you know, doing some of the planning for this a bit earlier. In addition, your transition service agreements also could have a big impact on how quickly you can separate. When you start looking at companies that are 12 to 18 months or 18 months or more, many of them were really trying to operationally separate and ensure they had minimal TSA agreements in place. So they were really trying to be as independent as possible upon the close of their transaction. While those that are closer to 6 to 9 months typically had more TSAs in place and were reliant more on the parent company, as they did not have, you know, enough time to get new IT systems in place or to do some of the other operational separation activities that would truly have gotten them independent. So shorter timeline, more TSAs, longer timeline, usually limited exposure to TSAs. As you see here, the mean duration on the transactions are on an IPO, you know, just over 8 months, where a spinoff is, you know, a little over 12 months. So some key things to note if companies are looking to go through this, it's not a short process by any means, and planning as you go through it. We can go on to the next page. some key things to think about, and as we looked at this, many of the activities could be formulated into two different buckets. One is the financial bucket, the preparation of the financial information that is needed for the actual transaction to happen on the capital market. So this includes the preparation of the carve-outs, the valuation that goes on, the tax planning and structuring that goes on to enact the transaction, obviously evaluation of synergies, the capital market communication, and that the investor story that is going to go on, and all the road shows that would take place, can all be in one bucket. And then on the other side of the transaction is the operational separation. And this is really, breaking apart your finance function and ensuring that you can report both on the parent company, but also report on the operations of the SpinCo or the divested carve-out entity. IT is a huge and typically significant area for companies to focus on. As you think about the impacts of trying to clone a system, if you're going to clone it, or if you're going to start with a new system for the carve-out entity. So again, looking at all those touch points that IT and finance and HR and your production, your supply chain, and your customers have, and determining how you're going to transition each one of those touch points from the parent company into this new carve-out entity takes a bit of time and is a significant work stream into itself. That work stream also feeds across, as it says here, there's intersections and interdependencies. As you go through the process of determining your HR and which employees will go with which company, and the employee matters agreement that comes out of that, that employee matters agreement feeds a lot of information related to the public filing. Obviously, you'll have to include the employee matters agreement in your public filing, but in addition to that, it feeds pro forma financial information that would be required in your financial statements. So there's a lot of touch points between the different work streams here on the financial side, as well as the operational carve out. And we suggest making sure that you have a significant sponsorship and a PMO over the top to coordinate all those efforts. The regulatory requirements here are quite complex depending upon which respective regulator you're using and which relevant gap or jurisdiction you're in, which stock exchange you're putting it on. So all those matters come into play as to what requirements are for the financial statements. The US is pretty onerous with regard to its financial reporting requirements. 3 years of financial information that may be audited, 5 years of historical information, pro forma financial requirements, are all key things that one needs to think about as you're looking to put a new company on an exchange. So ensuring that you know which gap is going to be required. If you're looking to put your company on a different exchange, ensuring what's required in those locations is going to be key, and really getting a head start on that. Financial statements go stale, so typically after 135 days or so, the financial information from the previous quarter is stale, and you'll have to do a new one. So ensuring that you have the right timing for when your transaction will close so that you don't do more work than required is going to be key here. So careful coordination on those regulatory requirements are key. And then lastly, we look at transitional service arrangements. And this one actually surprised me as we looked at it. The results here suggest that the duration of TSAs have a direct correlation to stock price performance, such that if your TSAs go out a couple years, you tend to see an uptick in stock price performance. We typically see our clients that are pushing to get off TSAs as quickly as possible because they believe the service levels are better if they were doing it themselves or if they were to hire third parties to do it. Usually the parent company is not the best provider of various services because they're not in the business of normally providing those services to third parties. So we typically would see companies moving to get off these, but the interesting results here suggest staying on those a little bit longer. It actually improves your share price, or the correlation to your share price. As you can see across the right-hand side here, there's a number of different types of services that are put under a transition service agreement. Many of those being in the IT, HR, finance function. We continuously see that, and usually the max duration, at least for spinoffs, is about a 2-year period, because once you hit 2 years, you tend to have implications to your tax-free spinoff status. So in that case here in the US, many TSAs will terminate typically at the end of 2 years, but there are some that are allowed to go beyond that. We did see, though, when the TSAs were indefinite, that we tended to see a decline. Again, many parent companies are not in the business of providing these services, and the longer you stay on it, the more hiccups you'll have in being able to change, reporting structures and things like that, because you're not necessarily in charge of gaining those reports and those IT services as easily as if you were controlling them yourself. So some interesting findings out of the study, and we're excited to share this with the public and get us some reactions to it.
Thank you, Bill. Thank you, Ralph. It's super interesting, that stuff. I mean, we here at the Edge, we look at primarily the reason for why companies do IPOs and spin-offs. I think often we get too caught up with looking at numbers, looking at projections, looking at all that sort of stuff. But you know what? At the end of the day, you should start with the reason, because that's what we do. We start with, what is the reason for them spinning off? What is the reason for the company IPOing? And you know what? In those statistics there, IPOs happen that much more quickly than spin-offs. And you say, well, why is that? And in my opinion, a lot of these IPOs, and this is something you should be very wary of as an investor, are just to make the management rich. So, IPOs frequently are clustered at the top of the markets, where you get lots of these things going through, and you're caught up in the mix of saying, hey, this is the greatest product, this is a great service, and you want to get involved, and then too often you find yourself in a loss. So that's something to look at. So these stats that Bill presented, for me, are super interesting. They should be for you, and you should really have a look at that in a little bit closer detail. So thanks again for that, Bill. I'm going to move on. I'm going to move on swiftly to our next guest. Some of you have seen him before when he's presented in New York. His name is David Marcus. Now, David Marcus runs Evermore Global Advisors. It's a mutual fund. Is special opportunities, I would say, David, special situations, and he always looks a real value man. Been around a hell of a long time, I'd say, gone through many market cycles, so knows, and he won't mind me saying, he's experienced some of the rough times and the great times, but I think that makes him all the better investor, quite frankly, and he's always got some fabulous insights to share, and I've seen his presentations today, and he's got some more to share with you as well. So I'm going to hand you over to David. He's going to take you through what he's got today. David, take your time. We've got some time, and yeah, go for it. And thanks very much for attending. Thank you.
Great. Well, thank you, Jim. First of all, I thank you for having me come back. I really enjoy being part of your conference. Obviously, this is a worthy cause, the Alzheimer's Association. So really, I appreciate being part of it. I've loved watching the prior presentations. I think listening to Paul, always interesting. I always learn something from Paul's presentations, and the work that you guys at KPMG did with Jim, really fascinating. And so for me, I've already learned a lot. But hang in there, everybody. I'll try to be accretive to the process. I'm going to just share my screen here. Bear with me a second. Make sure I share the right screen. Let's see what we got here. Share. And finally, trying to figure out how to get a full view. There we go. I assume you can see that. And if you can't, well, I hope you can. So I'm going to talk about special situations. That's what we focus on. I've been investing, I've been around a long time, as Jim points out. He said it a little more kind, which I appreciate. I've been investing now professionally for about 30 years, globally, especially in Europe. And we really just focus on finding ideas that are compelling, they're interesting, there's strategic change going on. It's mispriced value. We are value investors. I mean, at the end of the day, I think value investing is sort of a dying breed, but we think that you have to kind of twist it and tweak it a little bit to adapt and evolve. So we don't just look for cheap stocks. We look for cheap stocks that have catalysts. We're always looking for how is the value going to get from the stock to us as the shareholder. So I'll give you just a quickie backstory here, background, and then I'm going to get right into a couple of ideas. So I was lucky enough to work for Michael Price, one of the great value investors. I started my career there as an intern. I spent 14 years working there. Greatest experience I ever lived through. What's not on this page is I also was lucky enough to work with a man named Jan Stenbeck. Jan was a builder of a vast telecom and media empire in emerging markets in Latin America, in Europe, Tele2, Millicom, Kinnevik, Modern Times Group, a whole bunch of different companies. He and I were partners 20 years ago before he passed away. And I just learned so much about businesses and how they run from the inside out. Usually as an investor, you don't get the operating experience. So sitting on boards, helping them think about strategy, I got to go on the inside and really see how it works from the inside out. Really different perspective. As I say, we focus on deep value special situations. We're looking for catalysts. A 50-cent dollar with no catalyst is of no interest to us. We don't buy into reversion to the mean. We think that died a long time ago. We want to know something will get the value out. And the most critical thing, I have it in my logo at the top, invest like owners. We take an owner's mentality. Would we want to buy the whole company if we could? If the answer is no way, well, why should we buy any shares? So we think from that perspective, always that way. Go anywhere, be opportunistic, just have an open mind to ideas. Don't worry about what the next guy thinks, worry about the numbers tell us, the management, the situation. We want to bet on people at the end of the day. And so we spend an enormous amount of time getting past the numbers and getting to the people. We're betting on people. Companies don't run themselves. And so we like to say we're investing in jockeys, not just horses. It's critical to have the right people at the top of the business because ultimately they are money managers. We're allocating capital to their stock. They do well, they're going to create value for us. They don't do well, they're going to destroy value. It's just like a money manager. And so that's sort of the backdrop. Special sits, I call it Special Sits 101. I'm not going to read it to you. You have it here. We're happy to share the slides if anybody wants them. We want change. We want restructuring. We want, as I said before, value, and then things that are happening. Breakup, spinoff, restructuring, transformation, asset sales, anything that can get value out. The critical piece is to understand, is this group of catalysts going to get value out, or is there just change? Some industries go through change all the time. Look at pulp and paper. They're forever operationally improving and transforming and always going through change. It doesn't mean they're creating real shareholder value. It may just be so they can stay in place and maintain their market share. So we have to understand the nuance of those businesses to see if those catalysts are going to get capital to us in the form of returns. We love it when we can find hidden gems. So inside we love conglomerates that are deconglomerating. There's a gem inside, but it's masked by other things. The market will always value a conglomerate at its weakest business, which might be a decent business, but maybe it's low margin, low growth. So the market's needle goes right to that one. You peel that out, it goes to the next worst, and then the next worst, till it becomes the best, hopefully, when you get to the gem. So when we see the change that's going on out there, especially in Europe, where you have more activism, more M&A, more pushing for change, more investors tired of the BS and the stories of the old days of companies that forever pitch tomorrow stories, it's over. You got to get to the punchline. Are you going to create value? And it can't be a forever tomorrow story. It has to be a today story. So the stock that with that as a lead in, I have two ideas I'm going to talk about today. And I think they'll kind of showcase what I am talking about. The first one is called MTG, Modern Times Group. So MTG, this was actually created by the Swedish family that I worked with many years ago. This company was once the largest broadcasting group in the Nordic region, started from scratch. And I was on the board, but I left the board in 2012. So I haven't been involved. And because of the nature of the ownership from that group, I basically vowed that I would never own any of their stocks because I had such a good relationship with the founding family. So my view was, as long as they control stocks, I stay away. We can look at other things. Well, by a quirk of fate, their holding company in Sweden. So the backstory here is that MTG is a fantastic transformation story. In the years after I left the board, it embarked on an investment program focusing on online gaming, mobile gaming, and esports. As you could see here on the slide, they control 90% of ESL, Turtle Entertainment. ESL is the largest esports brand. They operate the competitive venue programs and competitions. Now, of course, during COVID-19, you're not getting 20,000 kids into any specific space. So that killed that side of the business in the short run, and they're evolving to more online-driven events. The other side of their business, the gaming side, is exploding, as you've seen for so many gaming companies. So why is this an interesting case? Well, I'll get to that in a few seconds. I wanted to finish my thought from a couple of minutes ago, which is why we were able to invest in this is because ultimately the company was, as I said, part of a larger group, which had the largest broadcast and streaming business in the Nordic region. Well, the holding company above it, called Kinnevik, wanted to buy, through one of their other assets, the largest cable system in Sweden. The regulator said they couldn't do it because they controlled MTG. So they had to spin off MTG to shareholders. On its way out, they were going to sell the Nordic assets to a Danish company and create kind of a breakup, a spinoff. It was a real transformation. Well, that Danish company, TDC, just as this deal was announced, they got a bid from private equity. And part of that deal was kill the deal with MTG. So the whole thing fell apart. But Kinnevik said, we have to spin this thing off anyway to shareholders because we want to buy the cable system. So they spun it off just I think it's just about 2 years ago now. Not even, I think just under 2 years. And they spun it off as MTG, and then they broke it into two companies. One is called Nordic Entertainment. That's the streaming with 3 million subscribers and broadcast. I hate to call something a mini anything, but I'd say it's like a mini Netflix. They produce their own TV shows. They produce their own movies. They have a multitude of programming throughout the Nordics and into Eastern Europe. So that's NENT. We own that as well. The focus, though, is the MTG. So they spun this off with the esports and gaming assets, and it has a ton of cash. So we have a company today that has no main shareholder. We are the third largest shareholder in the company. You have about, as we show here, about $950 million US market cap. We have about a little over 170 million in net cash. And this trades only in Sweden. And so the situation is that we have a vibrant, growing group of gaming businesses. We have the esports business. The company had announced they were doing a strategic review just before the pandemic kicked in. They were debating if they should stay a little conglomerate of all of these assets, or if they should split into two companies, one vertical being the gaming and mobile gaming, the other vertical being a pure play esports business. Well, they ended up suspending the strategic review as COVID-19 really took control of the world. We think that will come back at some point, but we don't care right now. We view this as having a horse, two horses, one in the esports race and one in the gaming race. And we're in what I call the land grab phase for esports. Now, value investors basically never get a chance to buy esports businesses because, as you would see if you look at any company that has anything in esports, the multiples are extremely high. The earnings are extremely low. It's sort of a tomorrow story, a wishful thinking situation. Here, because of the nature of the spinoff and then the subsequent breakup, it came out very mispriced. And because the new company retained the old name, it actually confused investors. All the banks in Sweden that were big shareholders, I think some of them for a long time thought they had the broadcaster here. This has no connect to the other company today. And so this company really is at a critical crossroads, as I point out here. Should they be in one or the other? We think opportunistically, this company can peel off the esports business at some point. Maybe they'd consider a listing here in the United States. I think that would be phenomenal for them. I think there's just a wonderful sort of, they're getting to a crossroads where there's sort of a lot of paths that they can go. So we have a company here today where the market is not sure how to value it. It only trades in Sweden, which but yet a lot of their business is here in the US. And then the real part of the opportunity is the growth in Asia. They recently signed a deal with Muzea for streaming rights. There's a lot of stuff going on. Muzea is controlled by Tencent. MTG also announced a deal with DouYu, which is also controlled by Tencent. There's all of these moving parts for Asia. You're not paying for any of that here. You know, Jim and his group have talked about spinoffs forever. This is a classic, if you ask me, opportunity of a mispriced spinoff where you're starting with a ridiculously strong balance sheet. You have management that just went through a transition as the old CEO retired and the new CEO, who was the CFO, she just took over. And at the same time, we have activists coming into the picture. So as I point out at the bottom of the slide, there's a group in Germany that owns just under 8% of the company, and they are now coming into the picture. And I think they just wanted to push to accelerate this transformation. But this is a company that has a lot of question marks on it. Why? Because is it a gaming business? Is it an esports business? The investment community is a little flummoxed on what they should be thinking about here. We love that. So we could keep adding to our position along the way. The last point I'll make on this, I know we only have a compressed amount of time, so I'm going to keep it very tight here, is that I'm on the nomination committee. So a little known secret about how it works in Sweden is that in most companies around the world, when you're picking a new board, usually the board itself creates a subset of itself to be viewing potential board changes, additions, deletions, whatever, dealing with activists that may want representation. The way it works in Sweden and also Norway is they don't look at the board to create a nomination committee. They look to the shareholders. So the three largest shareholders of the company are offered the opportunity to sit on a nomination committee. Well, the nomination committee helps determine, do we have the right board? Should we make any changes? In Sweden, there's no staggered boards. Everybody's up every year for election or re-election. And so I was on the nomination committee starting last year. I was just renewed on it because of our ownership. And I know last year we had one person leave the board and we added 3 new people, phenomenal people with industry experience. Somebody who came from the NFL, chief marketing officer, somebody who's on other gaming business boards in the United States here, somebody who came from Lego Systems, the Danish company. It was the former CFO. So we got great people to join the board as this Swedish company realizes it's a global business, which is finally realizing. And so the nomination committee, interestingly enough, has an enormous amount of responsibility and power to affect change. I don't need to get non-public information. I don't need to be on the board. I can do all this work from the nomination committee to really help the company evolve forward to the next level. So I think MTG really, it's one of our favorite ideas. It's not our largest holding, it's our second largest. It seems to vacillate depending on the day with another holding. But you have a cheap esports and gaming business, mega growth underneath it all, excellent management, and a looming strategic review to determine if it should stay in its current form or if they should merge pieces out with others or sell off assets. So there's a lot of optionality here. I'm not giving a lot of detail on the numbers. I'm trying to keep it a little more high level, but be happy to chat with anybody who wants to talk a little bit more about it. My second idea is, there we go, IAC. IAC is Interactive Corp. This is the company that was started by Barry Diller back in the mid-1990s, back when he took control of a bunch of UHF TV stations and transformed it. And the company, really what we have here is sort of right in front of, so this trades here in the US. You have almost 11 billion market cap. Their history of value creation is what I can only call phenomenal. We only own this 6 months, maybe it's probably since the beginning of the year. So I guess we're pushing 10 months now. The attraction to us was when they announced they were going to spin off Match.com to shareholders. So they bought Match back in the late 1990s. They paid a modest amount for it. And they did what they're so good at doing. They bought it, they invest in it, they build it, they ramp it up, they scale it up, and then they eventually spin it to shareholders. They've done this with TripAdvisor. They've done this with Expedia, Home Shopping, Ticketmaster, which of course today is Live Nation. Their process, it's like a phenomenal process of value creation that they have done. It's a wonderful machine. So they're not necessarily inventing new companies from scratch. They are, as I say, buy, build, grow, scale, and then eventually monetize through a spinoff. And so when they announced the spinoff of Match, which was going to be months later, so it came out at the end of June, even though it was announced, I think, even at the end of last year, over 95% of the market cap of IAC was in Match, meaning you were paying like nothing for everything else. And we felt that that was just a complete mispricing. These kinds of conglomerates tend to have mispricing. And so the spinoff, first we shorted out the Match side. We didn't want to take any risk on Match. And during the pandemic, as Match initially sold off, we covered it. And then when we eventually got our shares, we have sold them off subsequently. Match is a great company, but our real play is to own the machine, the whole, be there with Barry Diller and Joey Levin, who's the CEO. These guys are just unbelievable value creators. So after the spinoff, we have, it's simple. We have Angie's List. They own 85% of it. That's a listed company. That's worth about $50 a share. Per IAC share. They recently bought a stake in MGM, which is a little bit different from their normal. They don't usually go into businesses that are as large or as mature. The opportunity they see with MGM is on the loyalty program, the online and mobile gaming business, which is booming. I think MGM is let's say not as advanced as other companies. I think they have north of 30 million people in their loyalty programs around the world. There's a huge opportunity to really ramp that up. I think that really is part of the attraction for IAC. Well, that's worth about $15 per share. And then we have net cash of $35 per share. So you have $123 market cap between Angie's List, MGM, and cash. That's $100 right there. So you're paying, at this point, $23 a share. What are you getting? You're getting Vimeo, which is you may not even realize sometimes you're using Vimeo. It's a platform for all kinds of video distribution. I see a lot of presentations. When I click on them, it says Vimeo, Dotdash, Care.com. There's a whole host of other businesses inside the company. And so we have net cash, we have growth, we have a track record of value creation. We think the sum of the parts today is worth about $175. So the stock has moved up. After the spin, it was about $100, a little over 100. It moved into the mid 130s 2 months ago, and it's come off in the last few weeks. We have nibbled on it recently. We tend to be nibblers, not gobblers, meaning when things are attractive to us, we like to take small bites. If we take a big bite, we might not have enough capital to keep coming back. If it comes our way, we take small bites on tough days. And so we have a robust opportunity. Our NAV of about 175, We're not really putting very high multiples on any of these underlying assets. We really have been, I think, extremely conservative in how we think about this holdco, but we're buying a compounding machine. Now, some people are critical. They say Diller and his group, yeah, pay themselves very well. They do. But I think that the value creation, I'm not sure I'm going to say justifies that kind of compensation, but we look at the whole net to us as shareholders, and we're comfortable with what they're doing. They really, I think, are not given enough credit for what they've been able to achieve. I think if you added all the pieces that they've spun off over the years, you'd see a total return that would just freak you out, because you'd be just amazed. We're trying to kind of backfill into that. There's a lot of moving parts on that. And so these are the two stocks that we, that I would highlight. Let me see what else I have. Oh, that's just me. Forget that guy. And so those are my ideas. I think those are two of our larger holdings. As I say, we love owning these. We do very little here in the US. The US represents less than 20% of our global fund. We have about 70% in Europe. So when we do something here, it has to be really blowing us away, where we think this is so compelling that we kind of drop everything to work on it. That's what IAC is. So that's those are my ideas, and that's sort of who we are and what we're all about. Thank you.
David, thank you very much. Super interesting. IAC, definitely continued winner, really. Barry Diller, total value creator, but one of those guys where you kind of hear those companies in the background and you never really investigate them, and before you know it, they're household names. One of the more recent ones that we've been pushing was actually another spin-off from IAC, was Match.com. And, you know, this is just the space you want to be in. It's technology, it's growth, and you know, as the world becomes, you know, in my view, a lot more insular, things like Match.com, things like video dating, which, you know, is unheard of 20 years ago, and all this stuff is coming back. And so, if you're interested in you know, investments for the future, the next kind of growth phase, these sort of stocks you should be looking at. So super interesting, David. Love IAC. I think.
You have one more comment or not?
What's that?
I have one more comment to add. I just wanted to say, because I left something out. Maybe this is the most important thing. Maybe it's the least important. So we've been focusing on companies like this, but we've realized that we're at this environment we're in has created this quirky intersection of growth and value. What do I mean? It's like IAC. I have mega growth businesses trading at a value price with catalysts, with events, with things going on. MTG, the one I showed before. As I said before, you know, you don't usually get a value opportunity in esports. We're getting it now. So we're seeing some businesses, because of breakups, spin-offs, restructurings, there's a window where investors don't really fully understand it, and you can get these high growth businesses at a value price. The value investor says, look at this, it's cheap. Oh, and I'm getting all this growth. The growth guy on the other side's looking at it, says, look at all this growth. Oh, and it happens to be cheap. He cares less about the cheapness. But we can look at it from the other opposite of each other and end up in the same place. Highly unusual that happens. So I think, and it's not just these two stocks. There are others that fit the bill, and they're usually the product of some strategic event. And so those are things that we really are drawn to and more because they're out there. They won't last forever.
Thank you, David. Great. So we'll have one more guest on, then we'll take a 10-minute break, and then we'll proceed with a couple more. Jonathan, in-house deals analyst, and myself, hopefully last but not least. So our next guest is rarely you introduce someone as a legend. I think George Muzea is a legend. Now, George's background, and you know, if you ever meet George, you don't end up talking about stocks, you just end up talking about his stories. Now, and actually they're much more interesting, to be fair. But other than that, he does have some great insight. George has worked for over 40 years in analyzing insider buying. And that means directors buying their own shares, and not just directors going out buying, because, you know, he'll tell you himself that not all directors are very good at buying their own stock. So he has a process of looking at directors. He works closely with us at the Edge. It's one of our components where we look at stocks for spin-off or our situations, where we look to see if the insiders have been buying, how much they own, how much of the stock they're buying in proportion to their worth and things like that. So, and obviously how good they've been in the past. But George has been doing this for, you know, pushing 40 years. And, you know, he's worked in the likes of, he's worked very closely with people like George Soros and Stanley Druckenmiller. So, you know, he comes from a fantastic background, and he's got some ideas on some of the names we have in the up and coming calendars on special sits and spin-offs that he's been looking at for us. And again, it forms a basis of a start of investigation. So, you know, if you're a newbie out there and you want to look at companies, you should start really with the management. You know, how much they involved, how much they, you know, how much they liable if the company goes up. Are they going to make lots of money? Are they going to fall with a company? And that's a great impetus for successful companies that we find. You know, they've got great management interest. We just heard IAC, Barry Dilley pays himself well. Well, you know, is that a problem? Well, I like to pay myself well as well if I could jump on the back of Barry Diller and all these people. So, you know, it's the same with the Dolans as well. You know, MSG, you know, is another complaint. Well, they make themselves rich. Well, look at the share price. Can I make myself rich as well? So you got all these kind of people in the mix, and it comes down to how much they incentivize themselves. And it's a very concise area you should be looking at when you analyze stocks. So I'm going to hand you on to George. He's got a book that's been out for a long time, which I think is one of the most underrated books out there. It's called The Vital Few versus the Trivial Many. And really, it's just that. It's just about the insiders and the good ones out there and how to spot the good ones. So go buy that. And it's one of my favorite books. And we supply here to a lot of the interns that come through. So without further ado, I'm going to hand you over to George. Just give you some good insights into what to look at the moment, the stocks that they have the key insiders or the smart insiders. And so I'll hand it over to you, George, and thanks again for being so patient today.
All right, great. Thank you very much. Let's see, how do I, okay. Can you see this? All right, this is my book. Okay, Jim, can you see what I put up there?
I don't think you've shared your screen, George. I just want to share your screen there.
Can you see that?
No.
All right, great. Let's see. Oh, I got to hit share screen, I think, right?
There we go.
All right, okay.
That's great.
How's this show up? Can you see that?
Yeah, we got it. Thanks,
Okay,
George.
great. Okay, this is my webpage for those who might be interested. It's the name of the book is The Vital Few versus Trivial Many, but this is my website, vitalfew.info. And there's access to me here via my email, and there's a description of the retail services I offer, institutional services I offer, and one can contact me if one is interested in and ask me any questions or the nature of what I'm trying to get across. Okay, and then right now I want to go into another section if I can get in here. Okay. Let's see. Can you see this, Jim?
Yes.
Oh, good. Okay. Who are insiders? They are officers and directors of publicly traded companies. In general, insiders buy into price weakness and sell into price strength. This is what is really important regarding insider trading. The most important thing is to understand that insiders are value investors, and they will buy when stocks drop and sell when stocks go higher and into price strength. The SEC rules that govern insider trading in the United States, there's 2 days to report to the SEC via Form 4, must hold for at least 6 months before reversing or buying from rebuying or selling. It's an important distinction between Europe and the US. In the US, you have 2 days to report and they must hold for 6 months. They can't say that they're selling stock from 2 years ago. It's the last trade that they must abide by, so they can't reverse their positions. It's very bullish when they buy again at higher prices, which extends the holding period for another 6 months. So if you have a stock that has insider buying at 20, and then it goes to 26, and 3 months have elapsed, they only have 3 months before they can sell that earlier position. But if they buy again at a higher price, let's say at 26 or 27 after initially buying at 20, that's very, very bullish because it's extending the holding period for another 6 months. So they've held it for 3 months. So now it's gone to at least 9 months. So I've seen stocks where they keep buying as the stocks go up. It's very bearish when they sell into price weakness, which means they cannot buy for at least 6 months. So that if you have a stock that's in a downtrend and insiders keep selling, they keep putting off the amount of time they can reverse their position and start to buy. So that's a very, very bearish signal. In Europe, they only have 10 days to file with the exchange. They have 10 days as opposed to 2 days in the US. And there's no SEC and no holding requirements. So it's quite advantageous for those of you who are interested in European stocks because of the fact that it's like the Wild West. There's basically no holding requirements. The main types of insider buy patterns, the first is a value, which is basically they buy stocks. I found that the insiders will buy stocks if the price is near or below book value or their perception of intrinsic value. One of the problems in the past that I experienced was back in 1973, 74. And I learned my lesson back then when the market went down 60% from in 1973 from mid-February to the bottom in October, November. And during that period, there was a lot of insider buying, and I was a broker at that time with Oppenheimer. And I recall following their lead, buying on the way down. As it turned out, the market went up 60% the following year, and they turned out to be, fantastic for those insiders that kept accumulating shares. But for my clients who started buying we started buying in 1973 and all the way down through 74, and then when the market finally bottomed, many of my clients had left, had given up on me, taking their losses. So in 2001, 2003, in that bear market, and the 2008, 2009 bear market, I didn't get fooled. I think a lot of people did, because a lot of the stocks had insiders averaging down. They're value buyers, and I avoided that by waiting until the stocks showed some sign of basing and then turning. So my feeling is that value buyers will buy and come down on the way down. If you're managing money, you'll be very disappointed with your returns in general. So one should avoid buying unless a catalytic insider is among the group of buyers. And so we're going to go into that now. So, value insiders will buy primarily based on intrinsic value and or their perception of intrinsic value. Whereas a catalytic buyer, they'll only buy if good news is coming over the next 6 months. This could be an operating officer, it could be a director. If it's a director, I always look to see if what kind of history the person might have. And I have found that many of the catalytic insiders who are outside directors came from Wall Street and have excellent experiences with understanding the street's response to the news. So a catalytic buy pattern could be an insider with an excellent trading history, or 3 or more insiders with average histories buying into price strength. Buying into price strength is catalytic buying and an 80% probability of success. This is, in my opinion, one of the strongest insider patterns you could have, because if you think about it a second, excuse me, you have a company that has sponsorship and the stock is rising because of sponsorship, and insiders can buy additional stock at higher prices. This time when the good news comes out, excuse me, you'll have to forgive me. I'm in Nevada, and the air quality here is very bad because of the fires in Sonoma. So I'll have to slow down my pace a little bit. So the catalytic buying is what's the key, and so I would recommend for those of you who are first getting interested in inside activity to primarily focus on stocks that have already based and showing signs of buying interest. And then your probability of success will be much higher, buying into price strength. Earlier, someone was talking about IPOs. There's a special situation buy pattern where if you have a company where the insiders have bought the IPO price and we're within 6 months buy again at higher prices, that's a very bullish pattern. I can't remember going back over the years having a stock that didn't work out very well. Because you have to understand that when they buy the IPO, they're showing that they have an interest in the company. However, if they buy again at higher prices, now you've got sponsorship and the stock that's already in an uptrend. Very, very bullish pattern when you see them. The best insider short patterns. Over the years, I've seen so many mistakes made by hedge fund managers who short stocks. They will find overvalued stocks. They have a tendency to all short the same ones, and they'll short stocks into price strength, which is insider selling into price strength is normal behavior. So I remember I was sitting with Druckenmiller in his office, and we were talking about, he mentioned that I gave him some great short ideas, but all of my short ideas are stocks that are in downtrends. So it's impossible for me to short a stock that is in an uptrend and very strong, a momentum stock. And my feeling is you wait until the stock has gone down. For example, Enron is one of my great shorts. On the way up, they were selling, normal behavior. However, the stock went down from, I believe, 90 to 60. And around the 60 level, there were a lot of value buying, money managers, battery march, et cetera, that type. And they were buying, and they, I saw insider selling by the same people, particularly the CFO, who sold into that plateau around the 60 level. And that's when I put out a short recommendation. And that worked out very, very well because the stock disappeared. So do not short overvalued stocks when it says selling into price. Okay. Now I'm going to talk a little bit about a few ideas. Here we go. This is a stock that is, let me get it here. This Nefosa AB is a company that is based in Sweden. And I want to show you something here pertaining to this fellow. I can't even pronounce his name, or maybe it's a woman. In any event, take a look here. On May 6th, bought stock and then sold it 2 days later at a profit. Now, you couldn't see that in the United States because that's illegal. But you know, this is only a 2-day holding period. And then this insider bought again in May 14th and then sold the same amount May 25th. However, here's a divergence. Here's a buy in August. Here's another buy in September and another buy in September. So at higher prices. So this makes it, in my opinion, a very interesting buy pattern, and it's what you'd like to see. So this particular stock also was a spin-off. There was a spin-off involved. So the next stock is Pfizer, which has some interesting characteristics. And first of all, this particular, this is very unusual. This is the first year I've seen this, where they're starting to show political figures and their activity. Here you have Thomas Caper. Now, what's interesting, he didn't buy much, obviously, but let me just check on his name. Okay. This guy went to Ohio State University and earned an MBA at the University. So he's not just a well-educated person, but he knows a little bit about business. And let me just go back and show you one important characteristic of his activity is his score is 80, a little green arrow, based on other stocks, and he's got, you know, he's got 79 different directorships apparently. In any event, his score of 80 means he's right about 80% of the time, so that's quite significant. So I've been very, very pleased that I'm able to get information on political figures because they have inside information that we don't have and can't be prosecuted for it. That's one positive about the stock. The other one is Ronald Baylock. When I look at his trading record in these different companies, I see that back in 2008, his first purchase, he made 19% in 6 months, outperformed the market adjusted weighting by 26%. And then he bought again 6 years later, made another 84%, market adjusted 79%, 6 months. Here's his maiden buy in August 6th of Pfizer, reasonably good size, similar to this one, which is interesting. CarMax, he bought a small position here in 2013, made 12%, outperformed the market. And then in Berkeley, back in 01, his maiden buy, his first buy was, amazing, amazing returns, outperforming the market and making major. So clearly, this is what I look for from an insider perspective, unusual buying and unusual patterns. I never know why, and it's just a piece of information, but certainly warrants some further follow-up by those people who might be interested. Here's Cedar Fair. This is something that I'm seeing a lot of. Excuse me. There was quite a lot of value buying in March and April. Excuse me, in the market, but there's very little follow through. Have you not yet seen much insider buying at price strength? So, but I have seen quite a bit of stocks like this. This is Cedar Fair. Excuse me. Cedar Fair. Well, Cedar Fair. Here, you have the CFO and the Chief Accounting Officer, two very important insiders. These are operating officers, and in the US, operating officers are my favorite insiders, particularly if they're in the financial area. And here you have both the CFO and the CAO buying at 37. Now the stock is currently trading, in the mid-20s. So they're out 10 points and they haven't averaged down. And they bought in March. So clearly the question is why? Well, on November 3rd, they're going to report. In the past, I would expect that one would expect, and I would certainly expect to see them report the disappointing news. And hopefully at that point in time, if that were to happen, they would come in and buy. If they don't buy, that would be quite a negative. But in any instance, the most important thing is that there's quite a bit of companies like this that I'm monitoring. And we're in earnings seasons now. Over the next 4 or 5 weeks, we'll get the third quarter reports, and what happens then will be very revealing, in my opinion. Okay, so basically, from an insider perspective, from a sector perspective, from a macro perspective, the buying that I'm seeing now is in small regional banks. So those of you who have an interest in the financial sector, it's probably a good idea to focus your attention in the smaller regional bank area. These stocks have been really decimated, and because of low interest rates and the COVID. But now I'm starting to see quite a bit of buying in not the major center banks, the small regional banks. So you can all locate those near you or the ones you're interested in, and you might do some fundamental research on it. But I do have a list. If anyone's interested, I could send them privately. Just go to my website, vitalfew.info, and I'll be happy to forward my list. So that's pretty much it, Jim.
Thank you, George. That was really insightful. Just to say with George's picks and highlights, really forms a basis for a lot of the ideas we have, and he picked some out the Spinoff and special sits calendar there. Pfizer, I know, is one that I personally like, with the insider buying, paying up for stock. I mean, you know, you just got to realize that insiders, they're the people who know, right? They're the people who know what the company's going to do. I mean, if they're paying higher and higher prices for their own stock, there's something going on. So when we start to see that, even with against the catalyst, and something like Pfizer is just like that. Insiders buying, who have a great track record, who are buying into a catalyst, you know, and then the numbers add up. You know, that's a very powerful signal for a special situation. So, you know, you should look to take that into account. Like I said before, the insiders and how to incentivize and whether they're buying their own stock. However, you know, one thing I know George usually mentions, I'm not sure you did, but it's people putting money in their own pockets, not stock options. So when they actually take money out of their pockets and they put their own money into the stocks, it's very, very powerful. I mean, they're putting their own money on the line. So that's something definitely to watch. But I appreciate that, George, and thanks for joining us today. And it's a bit dusty up there, but thanks for soldiering through there. Listen, we're going to take a 5-minute break, 5 to 10 minutes actually, and then we're going to come back. We'll have Jonathan Morgan, he's our in-house deals analyst. He's going to present the 3 best ideas we have at the moment, and then we're going to finish with an idea of mine in the activist space, which is something we've been, you know, gaining a lot of notoriety on actually, and being quite right. And then we're going to finish with a Q&A. Seeing lots of questions come through. Keep sending those through, and we'll endeavour to answer as many as possible. But let's take 10 minutes. We'll resume here at let's say just before 12:30, and we'll go from there. But thanks for staying with us. Hope you're enjoying everything, and just don't go away. Thank you. Welcome back.
Right there.
You got a little bit of Vaseline action there over your
A little fuzzy. Yeah, I'm trying to figure that out. There we go. Oh, it'll come back.
Bill, your microphone's muted, Bill, just so you know. Okay, pause here. Okay, hopefully people coming back, or maybe not even left. We thought we'd have a little Q&A, change things up a little bit. And just because, you know, people press for time, and, you know, we want to answer some questions as well. And, you know, we've downloaded a lot of information to the audience today. We've still got a lot to come as well. But I thought with our guests, you know, we don't want to keep them waiting forever, but also, you know, we want to get some of your questions answered. So I'm going to hand over to Paul Johnson. We've been collating all the questions that are coming in. I know there's some good ones in there. I know that he's got some himself. So Paul, I hand over to you, and yeah, go for it.
Yeah, no particular order, but this is a question that I wanted to ask, and somebody else asked it. So this is for you, David. I was very impressed with the commentary you had around Sweden's, what I'll call governance rules, but the way it was asked was allowing shareholders to really help influence governance, selection, and all that. The question directly is, could that be adopted in the US? And I think you can riff on it a little bit, not just could it be adopted in the US, but are all the governance rules in the Nordic countries better? Obviously, that seems more shareholder friendly. We've really moved away from that in the US, where often the CEO controls the board. You obviously know this topic, and Harry, I'll stop talking. You can go ahead and riff.
Thank you. And thanks for the question. I think it would be hard to make those changes here in the US just because it's so ingrained a certain way here. I think it's hard to do. I think it's a great situation where you go to the shareholders, and the 3 largest comprise this nomination committee. I think maybe the problem here would be you get some big hedge funds that would just take big stakes and start trying to change boards without this whole proxy system and so forth that we have. And by the way, just because you're on the nomination committee doesn't mean that you control the company. But what happens is, like when I joined it a year ago, the company had just been spun off, and there was a move from the board, from some institutional investors, let's leave the board alone. And my view is, no way, here's our chance to change things. change the board to be in line with the company. And we did. One person left, three people joined, and we recruited some phenomenal people. You still have to go to a shareholder vote, but since they're the company's nominees, once the nomination committee nominates them, they become the company's nominees. It is coming from the inside. So it does work well. I just think if you bring it here, here you have all kinds of things, staggered boards, all kinds of other levels. And it would be interesting to have it. I just think it would be hard to have it. And I do think the other side of it is that I think small groups of investors could really dominate some companies, inadvertently sort of, it kind of maybe outfoxes the intention of what this is for. I don't think all the rules in the Nordics are better than the US. They go back 10 or 12 years ago, they didn't even have insider trading rules. I think George touched on some of that. There's still a lot of wiggle room on trading for insiders there. But this issue on the board, it's great because really the whole board is up for election theoretically every year. There's no way. Now, you'll have people who have been on boards forever, but it's because they continuously are adding value and it gets renewed. I'll tell you the thing that I'm promoting right now on the nomination committee, and this is the hard part, is to get incentives for board members, meaning, what do I mean by that? Stock-based compensation. Most of the companies in Europe are paying the board members at a very subscale level, and it's cash comp, which means you can't recruit the best people in some cases. Some people are going to do it anyway. They love being on the board. They think they could add value, whatever. But the numbers are low, and I can tell you it's a battle because the institutional investors are afraid if they do it at one company, it's the first of many dominoes to fall. But that's a big thing for me because I know as these companies become more global, you need to recruit the best people you can for these boards competitively. But it's a way you can be an activist investor without being an activist investor. I don't have to be pushy. I don't have to do anything. I can, through the nomination committee, help make a lot of changes.
David, just a quick follow-up on that. The fact that we have these governance rules that really make it very hard to be more actively involved, not maybe take you to the activist level, but you can influence the leadership, particularly the board. The fact that in the US, that's so hard, and my screen's bouncing around. I think Georgie just went to share. Does that limit, is that a factor when you look at US companies, or is that just a bonus in the Sweden companies you're looking, but not enough of a negative in the US, it affects your filters?
I think that, look, for Sweden, they take an owner's mentality. They really do. Whenever over the years we've had a bigger stake in a company that did not have a main shareholder, they take this main owner mentality. So you own 10, 15, 20%. I've had it where the chairman will call me and say, hey, you're now the largest shareholder. We'd love to chat and get your perspectives on direction and things of that nature. I'm like, really? I had that response initially years ago. I wouldn't still have. But the point is, I was just so surprised. They do take this sort of grandfatherly approach. If you're the biggest owner, we should listen to you. Doesn't mean they're going to change everything, but at least they're open to thoughts and ideas. Now that has dissipated over the years, I think, as more activism has grown, where you have people who just want to break companies up and really, blow it up and just short-term value create and then press on to the next thing. So it doesn't happen as much that way. Yeah, here in the US, I always think taking an owner's mentality is critically important when you're investing. You really have to think like an owner of a business, and decisions should be made in that regard. That puts you at odds with people who want to do things that are going to create ridiculously short-term pops. But I think having management that's aligned is important. So I do think some elements of what you have in Sweden and the other Scandinavian countries are good, and it would be nice to incorporate more of that here. There seems to be an attitude here, you have it in the UK as well, which is, who do you think you guys are as shareholders? You're just shareholders. They don't have there's not an owner's mentality here for shareholders, right? As you pointed out, the CEOs dominate. The CEOs control in some cases, and they think it's their company. Well, it's not their company. unless they're amongst the larger shareholders. And I think sometimes the companies forget that, and very quickly they're at odds with their shareholders. And so having a vibrant board is critical, with people with different backgrounds and experiences. As I say, the nomination committee, look at the one that we just seated at MTG. It's me, it's a guy from the activist group, and it's one of the larger banks in Sweden. Last year, it was me and two guys from banks. And those two guys were each on 30 or 40 nomination committees. In fact, not one of them was on an actual board. They were just on nomination committees. They're professional nom-com guys. And so it was just an interesting process to go through, but we were able to make really good changes to the board because everybody had an openness to elevating the situation for the company. So maybe it's predicated on having that as well, where in other companies, they're just not listening. But this particular company that I've been talking about, it had a main shareholder since its inception up until 2 years ago. So I think the nomination committee was more of a, what did the big guys want? Because they had 50% of the vote. So it does change along the way. But no, I think there's a lot of positive characteristics that I would love to see come this way. It would be nice to harmonize some of these rules.
Yeah. I won't riff on this, and I want to hear from you guys, but I think that's one of the big failures of corporations in the US. And I even think the private equity partially exists because the governance is so bad. So I appreciate that. There's a question for Bill. Follow up on your presentation. With TSAs of a max of 2 years and the tax consequences at risk, does it mean spin-off companies could be sold after 2 years?
Yeah, I think in Jim and his team, I think do an analysis of this regarding when companies come off their kind of 2-year spin-off date and what the potential is for additional valuation to come out of those companies. So absolutely, it seems like after that set period, they're no longer in risk of jeopardizing their tax-free status. Jim, I don't know if you want to talk further about your analysis and what you do there, but.
Yeah, absolutely, Bill. I mean, so we looked at companies over the last 20 years to look at that very rule, right? There's the 2-year tax rule in the US where, you got to pay the tax if you take a company over, right? So after that 2-year rule, essentially acquirer can come in and do that. And as you well know, spin-off companies are usually niche, they're usually small, they're likely to be acquired. There's around 30 to 40% get acquired around that 2-year period. But, people are getting, or acquirers getting a little bit more smarter now with the moves in the market. What we try and identify are not only stocks near the 2-year rule, but stocks that are falling out of favor. And that's where, if you want to be a real acquirer of a spin-off company, you're going to look to, maybe the stock's in a little bit of stress or the market's fallen, it's pushed it down a little bit. But, we view those as real value plays, actually. But yeah, absolutely. I mean, 2-year rule in the US is what it is. But in Europe, there aren't any rules on that. They can be taken over at any point. So, and George's stuff comes into play there, where we see cluster buying of CFOs, of CEOs, and all those sort of people ahead of something big like that. But yeah, that's what we found.
Excellent. This question for George, a 2-part question. George, how do you rank insiders? You said several times this insider has a rank of 80. Is that an empirical work that you do, or is it? How do you come up with that ranking?
It's a proprietary index that we have a computer ranking with the company, and basically it involves looking at every stock that they have bought, let's say on the buy side, every stock that they've purchased, and then checking to see what the 6-month and 1-year returns would be relative to, and then having adjusted market weighted returns, depending on what the market was doing. So if the market was up 30% and the insider made 30% on the stock, that's not, it could be just the market. But basically, in general, we're looking for like a 30% return. And most importantly, when he's wrong, we want the result to be flat or a minor loss. So it approximates to a percentage of how many times, what if a person is ranked 80%, 80, that would mean 80% of the time he makes an average return of at least 30% over a 1-year holding period.
Got it. Quick, and then a follow-up question on that realm. What do you think about insiders, particularly management, that exercise options sort of right away? They're granted the options, they exercise them as soon as they can, often in a cashless transaction. Is there any kind of insight you're getting on that? Or is that just compensation and not really stock activity?
No, if an insider is exercising options, and the vast majority of the time they're selling stock the same day to make a riskless trade. And the reason they're making a riskless trade is that the difference between the exercise price and the market value at that time, regardless of whether he exercises and holds the stock or exercises and sells, he's going to pay 20% tax on the profit that he made between the exercise price and the market price. He's going to pay that tax to the IRS immediately. So there's really not much of an incentive for them to exercise and pay the tax and then hold the stock unless they feel they want to hold for at least a year, where the tax is the capital gains tax on the year holding, it might be 18% as opposed to say 40% if they're in a 40% ordinary income bracket. So you don't see too many times where insiders will exercise and not sell. But when it happens, it's a very bullish event, because that means that they're willing to pay the tax of 20% on the profit, and then hold for a long-term capital gain. They're putting themselves somewhat at risk by doing that, because if the stock drops, they've lost the opportunity to make that profit. So it depends on what they do, but it's normal for them to be exercising and selling the same day in a riskless trade. It's only when they diverge from that normal behavior that I get interested.
Yeah, that in the 1999-2000 bull market, I know personally several dozen people that did just that because they thought the stock was going up. And by the time the tax bill was due, the stock was worthless and they were in trouble. So I understand that. All right, so this is actually a question for George and David at the same time, because it's an insider buying at IAC. Eisner bought $5 million worth of the stock at the same time. CAO, I'm not sure who that is, you guys probably do, sold 58% of their ownership after the spin.
Yeah,
how do you reconcile this?
Well, the large sale by the large percentage sale by the CAO, I don't think it's as significant as the purchase, because the buying is a positive event, whereas the CEO would draw attention to himself, and the SEC might pick up on that. So the probability is he's selling his position after the spinoff, because he might fear that maybe he doesn't like, he might be kept by the company, or it might be a personal thing with him. But whenever there's an insider selling, you never know why they sell, but if they sell large percentages, that might get picked up, and so I would place more value if they buy. Now, if there was no buying by Eisner, then I would be a little bit more concerned, but I don't think it means anything.
David, do you have any follow-on thoughts on that?
No, I think you've kind of covered it. I do think, maybe just to say simply, I do think, like George, we look at what insiders are doing, but then you have to do a lot more work, right? Because as you point out, is it tax related? Is it something else? When there's a spinoff, what does it mean? A lot of these guys are paid very well with stock. And so from time to time, I've talked to a lot of CEOs over the years. They like to, there's this mentality of US guys are more inclined to keep more When you go to Europe, a lot of these guys, they do sell very quickly because their view is everything I have is connected to this one company, and they want to take some of it off the table. You don't have as much of an owner's mentality in some of the markets outside of the US amongst the management team, unless they're from the founding group. And so you have to do more work, but it's sort of a great sort of cut, and then you have to drill down and understand more. And we'll ask them about it usually. But a lot of times it is tax driven more than anything.
And in this case with Eisner, who's clearly very, very talented, very smart.
Yeah.
You know, him buying stock is generally you would view as a fairly bullish.
Yeah, that's exactly right. If absent the buy, I would be, probably more concerned. But the fact that Eisner bought, and it's more meaningful to me.
Got it. Follow up for Bill. Bill, I think those of us that are investors love your work because it's rooted in very serious research and analytics. But I suspect that hedge funds are not your primary audience. If I'm wrong, please correct me. So your audience is management. What's been the receptivity of boards or companies to your work? Are they, is it pure defensive? We should know this because we're worried about activists, or is it, hey, we should think about this because it's actually good governance?
Yeah, great question. We're actually seeing a positive response to many of our meetings with management around the results of this paper, as well as some of our other topics. While some of this is motherhood and apple pie, for some, there are a number of things that we bring out to light, specifically around the complications around the separation activities and things that they need to think about. Our process is really about de-risking the timeline that management has as they go about doing their separation and completing their transaction and ensuring that they get the most value for their transaction by having a complete story as they go to market. So part of our process is about helping management craft their story, as well as helping them execute against their separation plans and ensuring that they don't find any additional risks or concerns along the way that we didn't identify early in the process that they could plan around. But with regard to some of the latest facts and figures that we're showing them, some things are interesting. As I pointed out, the TSAs was an interesting concept as we came out and started showcasing some of that, because it goes against some of the things that people thought where TSAs should be short. TSAs should be something where you try to get off them as quickly as possible. And some of the research here showing that shareholder value is such that around 2 years or so, they're still staying on board.
David, you look like you responded to that. I didn't know if you want to add to Bill's.
No, just I'm just agreeing with it.
David, for you is how active are you? Are you active in governance? Are you activist in strategy? Is it just situationally dependent? Very much the case. Talk about what you mean by being active in these companies.
Sure. Look, we're not activists. In the past, I've done activist situations. I've done proxy fights in Germany and in other markets in Sweden. It's really not what we want to do. So we take a fresh look at each case. If an activist comes in, we'll look at what the activist is proposing. Sometimes we will jump on board with the activist. Sometimes we will help the company against the activist. We're thinking about value creation over longer periods of time. We're less interested in the smash and grab guys, the guys who are trying to get in. My example is it's like the guy at the jewelry store, runs in, smashes the cases, grabs the jewels, runs down the street and sells them. Now he's got to find another jewelry store. So that's like the quick and dirty way of some activists. They just want to make a buck and move on. If we can create more value over time by supporting the company against sometimes the activist wakes up the company and they'll make changes. So we really look at either side. For us, it's things like being on the nomination committee. It's softer. Can you help? Can you nudge? Can you suggest? With small and mid caps, especially in Europe, we will say to them, if you need to restrict us for a short period of time, we're willing to do that. If you're thinking of doing something where we can be helpful, we've been in the markets for so long. If they're doing a deal, can we be helpful as a sounding board? They're hiring a banker. Are they hiring a bond banker for an equity deal? That's a mistake. Some of these guys are good at their business and they're not always good at the capital markets. So we try to be helpful with companies where we can. The best cases, of course, are where the management themselves are the activists, like at IAC. We're not talking to those guys about what they should do. They know what to do. And so when you have companies that really are sort of leading it, that's at the top of the list. But we also can be helpful with companies, especially if they're going through changes and they have a multitude of paths to go. MTG is one. We're not going to tell them what to do, but we can say, you know, we've done analysis in different areas. Have you thought about this? Have you thought about that? But we're not here to run businesses. We're not here to tell them how to operate. We want businesses where we like what they're doing. But as I say, sometimes we could be accretive to their process along the way. And I find for us, that's a better approach than coming in as these aggressive activists, which, as I said before, I've done in the past. It's just less compelling to us to do that. I'd rather sit back and have the company doing all the hard work, and we can compound over time if we pick the right names.
And just a quick follow-up, it sounds like if you guys are very comfortable with the board you put in place and you really like what they're doing, in a sense, you're happy to sit back and let, as you just said, them do the heavy lifting. And it sounds like your favorite lever, if you're not 100% happy, is make sure you're happy with the board and how involved they are, because they're going to be able to do stuff you can't do. And if you trust them and they're thinking long-term value creation, all that, you feel more comfortable about the investment.
That's right. I mean, look, it goes back to what I said during my presentation. We think about the jockey. Who's running it? It's the management. It's also the board. Did the CEO put on a rubber stamp board that just does whatever he or she wants? Or are they really adding real value? And you can see that when you look at boards. Not every investor looks at the board and looks at the components of the board. We do. We think it's critically important to have a good, vibrant board that's a sounding board for management, but also nudges them and pushes them to do the best that they can do. It is a symbiotic relationship if it's done properly. And I think that's critically important. As I say, you know, we take this owner's mentality. When you have the right leadership, board, and management, you just see they make good decisions for the long term, and you should be able to sit back. They're doing the work, they're compounding. That's why we also have a fixation on family-controlled businesses, because these families that have been around for generations tend to make decisions that are not for this month or next quarter. They're to create longer-term value. Doesn't mean they're going to get it right all the time, but it's a longer-term decision tree where they're really making decisions for the out periods. And as they hit the milestones along the way, that's how you can grade them. Whether it's a John Elkin at Exor, Fiat Ferrari and other companies they control, Vincent Bolloré in France. There's a whole bunch of these guys that have been compelling value creators over extremely long periods of time. And so you can look at the history to prove out this point.
Excellent. This is a slightly more open-ended question for Bill, David, and George, and you're all going to, I think, answer it in a very different way, and that's COVID-19, not the political aspects of it and the political theater we've had this week, but how's it changed, George, the way you think about insiders? Is this an overlay you care about, or just very comfortable that the rules have worked so well for so long, I don't need that macro? I guess, Dave, I'll just answer it all to you and you can kind of go in series. David, after that, how has it affected the way you kind of think about these companies, how you think about the macro environment? And you're thinking longer term, but COVID is, you know, precursor to other kind of pandemic type situations. And then Bill, I guess for you, because you're really consulting board CEOs, how has that entered into your discussion? So George, why don't we start with you, go to David, go to Bill.
Yeah, that's a really good question. I should have brought it up myself. COVID has really affected my work pretty much, because there was a massive amount of insider buying by value investors in March and April, right at the bottom, because so many stocks had abruptly dropped below book value or their perception of intrinsic value. And you know, in the past, I have waited for the stocks to base and turn and see insiders pay up, because I've had those bad experiences in 1974 in that terrible bear market. And also I saved a lot of money from many customers, hedge funds in the 2001 bear market, and then the 2008. Because of this, and because of COVID, and it happened so abruptly, I neglected to really push hard for my clients to buy value. I did put out a buy signal on the market, but every conference call I listened to, there was no forward guidance. They actually eliminated forward guidance, and there's been almost no, except for a few minor cases of insiders paying up for stock. The ones that got in March and April and have the big profits, I'm starting to see some selling, but there's no buying. Now the selling is profit taking, but there's still a lot of lack of visibility. So normally insiders can see out about 2 quarters. I mean, they can talk about, the future being great, 3 years, 5 years, but it's all BS. They only actually can see out about 2 quarters. And the rest is they're just like us guessing. But when COVID has created an atmosphere where there is no visibility because of the unpredictability of the virus, so it's really affected the catalytic type insiders because there's no because the visibility is not there. So it has changed things, and I wish I had. I wish I had pounded a little bit harder on some of the stocks that I saw insider buying. And like, for example, one of the stocks was Caesars, the El Dorado. It had insider buying right at the bottom. And, but there was never any follow through, and there's no buying up here. So it makes it difficult for my work.
David, I know you have a hard stop, so take as much time as you want and then drop when you're done.
Okay, yeah, I'll do it, and then I'll unfortunately have to go, sadly.
Yep, great.
The bottom
and thank
line
you, by the way. Thank you.
No, thank you. Look, we made a number of changes when the pandemic kicked in. We reviewed every position in the portfolio, and we said, we can't wait for managements to figure it out. How can this impact our investments? And frankly, we made a dramatic shift in the first and second quarter. We've had a tough year so far, but the fact is we made a dramatic shift because we said we got to get away from the most cyclical and commodity businesses. They will be impacted. And so, and simultaneously with that, what I talked about before, where you have value and growth intersecting in a number of areas, we made this shift where we were getting out of things that had a commodity aspect or cyclical aspect, and we were able to have more business that had underlying growth and yet were cheap stocks. And I think those tweaks that we made in Q1 and Q2, they're starting to pay off now, and I think they're going to pay off really well going forward. If it wasn't for COVID-19, we wouldn't have gotten those opportunities. So it's kind of perverse that the thing that caused us a lot of pain has at the same time given us what we think are compelling new ideas. We didn't make wholesale changes where we changed the whole portfolio, but maybe we had 9 or 10 positions out. We have less than 40 positions. So we had quite a bit of the names go out, and we've replaced them with things that are cheap, with growth, with catalysts, with all kinds of change. And I'm away from that cyclicality that can be fantastic when it's in your favor. I'm so sorry I have to drop off. I really would like to continue here, but thank you so much for
Thank you, David.
part of
Thank
this
you
today. Thank you.
All right, Bill, you're up.
Yeah, as we look at COVID and its impact to us and our discussions with management over the course, a couple things come to mind. One is the timing of transactions. How is the COVID scenario going to impact your ability to go out and actually operationally separate, knowing that you necessarily can't be on site to review all your shared facilities and break them apart and do different things to operationally separate. How do you get new systems set up and clone and everything else if you're not, on site with some of these? It's actually going to take a little bit longer. So some of the discussions that we've been having is about the length and duration that you should be thinking about in order to enact the transaction. The second thing that comes to mind is around the story, right? Typically in these types of transactions, investors want to see the trend, and only having kind of the last 6 months now under COVID, there hasn't been much of a track record, a trend, and nobody knows yet how the company is going to evolve and come out of COVID. Is it going to be a quick evolution out, or are you going to be stuck in this environment for the next 3, 6, 9, 12 months? So, having that investor story and that value story and a track record to show how you perform in this environment is kind of the key. And I think goes to a little bit about what George was saying and how we're talking about it, which is, understanding what folks are looking for with regard to your operations. And while it's difficult to forecast and provide forward-looking thoughts, you need to provide the street with something. And trying to put some estimates out there and ranges of where you think you're going to come in are some of the key things that we're kind of coaching management with today.
Excellent, excellent. Jim, I'm going to hand it back to you, but there was actually a question from me. I'm so delighted there was at least one. The question is, am I saying that traditional value investing is dead and that those metrics do not matter in terms of investing today? Sort of yes, sort of no. I'm a very traditionalist, fundamental analyst investor. This is how I teach my course at Columbia, which is you've got to look at the cash flows, not today's, not tomorrow's necessarily, but future cash flows and over time. And growth is always a component in that. And it can be big, it can be small, it can be negative, it can be positive. What we're trying to tease out is to give people a way to think about how much people are paying for growth today and some of these big cap stocks. In the ideal world, to me, value investing would be getting growth for free. So if I can buy a company that I think's got 5, 6, 7% growth, which a lot of people don't think is growth investing, but compounds at a fantastic rate, you can buy that close to earnings power value, not pay much for growth. I think of that as modern day value investing. I think the challenge I think modern day growth investing is musical chairs. Nothing wrong with it. It's a very effective discipline. But keep in mind, the only thing that matters is growth. The only thing that matters at Amazon is growth. The only thing that matters at Chipotle is growth. The only thing that matters at any of these companies is growth. Don't get caught up on competitive pressures. Don't get caught up on anything else. You're paying for that growth. The moment the growth slows down, everything else matters, important, and valuation. So when you look at Amazon, 90% of the value is based on the future, which is fine. It's been that way for 6 years, been a monster stock. If there was ever a challenge to the duration of their growth, that stock's gonna get crushed. So just be disciplined. If you're a modern day growth investor, you're buying growth, that's all you care about, and monitor that very closely. If it starts to change, you better think about your exit strategy. If you're a modern day value investor, I think you want to pay as little for growth and buy as much growth as you can and pay a little for it. I think these tools are very helpful in all that. So with that, Jim, we're handing it back to you.
Fantastic, Paul. Thank you for that. Bill, George, listen, we got a couple more sessions, one with John, one with myself. If you want to stick around, you're very, very welcome. If you don't, you have to go.
Can I ask a question?
Yeah.
I don't know if Paul's still there, but I'm just curious. Biden, the market's expecting Biden to be elected, but Biden is basically, I've heard him on many occasions mention that one of the first things he wants to do is to make sure that Amazon and other FANG stocks are paying their fair share of tax. And so what effect would that have on the FANG stocks and the growth model that Paul might have if taxes were to be raised on these rapidly growing companies? Just curious.
Yeah, I think it's a good question. I think number one, he has to actually get it passed. He's got to get it past Congress. He's got to get it into the tax code. Number two is, and I know Bill probably has more experience than I have. The tax code is immensely complicated, 740 pages. These corporations pay a lot of money to dodge taxes, which I think is obnoxious, but investors love it. So you got to get past that. And then third is on like Amazon. Amazon makes so little money that even if you did tax them, not going to have a huge impact. Certainly not going to have a big impact to earnings power value. Perhaps it has a bigger impact long term when people think they're going to make $1 gazillion. Then you got to take that into account. I can't imagine Biden's going to be able to raise taxes that much. maybe we go back to where we were and before the last tax cut. And oh, by the way, the valuation in Amazon didn't really go up much because of that. So I can't imagine it's going to go down a lot because of that. Although, you know, investors are finicky. So I suspect in the end it's non-event. As long as the growth continues, it's not much of an event.
Thank you. All right, fantastic. Well, listen, Bill, stick around if you want. George, stick around. Thank you very, very much for being on today. I really appreciate it. I'm going to screen you a go blank. I'm going to bring in Jonathan Morgan. He's going to give you some ideas on some names coming up that we're looking at, that we think you should be looking at too. And after that, I'll give you a quick overview of what I think is the next big activist idea. But stick around, and hope you're enjoying it so far. Just sit tight for a couple of seconds, and John will come in.
All right. Hello, everyone. So as Jim mentioned, I'm going to highlight some of the situations we're talking to our clients at the moment. I'm going to share my screen now so we can talk through some of the ideas. All right. So yes, so as Jim mentioned, my name is Jonathan P. Morgan. And I just wanted to also echo Jim's appreciation to everyone who signed up for this fourth conference. And it's our very first webinar to help support this worthy cause, as well as to gain some access to our unique ideas and insight into the space. So we appreciate that. And as the senior global deals analyst, I've been working with Jim and the analyst team for over 10 years now. My role is not only working closely with our clients, with the ideas, and working with Jim on the idea generation as well, but also looking closely and working with clients around data support and spin-offs and special situations. So we're also looking for more recently new activist ideas. So that's a fit their criteria. We're working with activist clients as we speak. And that's also a very exciting situation for us. So now that this is my fourth presentation at our annual fundraising investment conference, what I thought we would look back at some of the previous conferences. And the first one actually back in June 2018, we looked at investment opportunities in the spin-off timeline. So we looked at our proprietary data at certain stages of the breakup. So what sectors work better, what size companies actually did well. And, you know, we had four buckets, if you will, 4 buckets. So we looked at announced spinoffs. So from the time of the announcement date to the spin date, is there a outperformance there? We've also looked at companies trading within that 2-year gap and looking for opportunities there. So both the parent and the spinoff. And then, as Bill would have mentioned on the taxation side, post this 2-year tax-free rule, and what the next, at that time for the conference, we were looking at the next takeover play. And funny enough, we actually highlighted a company called Varon Medical Systems. So VAR is the ticker. And it's about a 10 billion market cap company, oncology, radiation therapy, and devices. And the company was taken over by Siemens Healthineers a couple months ago. So that was one name that we highlighted in the conference. And then the fourth bucket, that fourth bucket, if you will, is those pre-announced potential spinoffs. So where we identify the road to change, being visible for an activist to get involved and be the catalyst for that stock. At the second conference, we investigated where to find value in spinoffs. So we expanded our data from 15 years over 20 years to look for some of the opportunities, whether the spinoffs, special parent companies as well. So 1-year view, hit rate, best sectors, etc. And then at our third conference, we spoke about the misconceptions of spinoffs in the market. So do spinoffs make money? What is the data telling us right now? And what opportunities you should be looking at today? So for the next, I would say 15, 20 minutes or so, we're going to discuss our best special situations ideas to watch for. Jim mentioned 3 names, but what I'll do is I'll mention one from the spinoff universe and one from our special sits, and also give an overlay at the end of situations that are coming up on the calendar. So we'll do a one-on-one, if you will. But all these names are currently model portfolio names. So these are holdings that we have a high conviction idea on. So it keeps us accountable when we say we like this situation at this level. So each idea, interestingly enough, has an element of what David and George would have highlighted today. So an element of management backing up their confidence in the company by buying shares in the open market. So spending their own money to increase their stake. And the first company we're going to be looking at today, it comes no surprise, with its spinoff coming up, is going to be Pfizer. So well-known mega cap, multi-conglomerate, multi-pharma player, and they're going to be looking to do a spinoff of their off-patent branded and generic businesses. Upjohn, it was a segment that they're spinning off, and they're going to combine that with Mylan, another generic maker, to form the world's largest generics company. And that's going to be through a tax-free distribution. It should take place in the next month or so. So we've done the analysis. And as George indicated in his presentation, there's a smart insider buying ahead of that spinoff. So we've looked at, as mentioned, Ronald Blaylock buying shares in the company itself. He has a track record of getting it right in the past. And we also, for the first time, saw another insider, former FDA commissioner, who is on the board of Pfizer. He bought earlier in the year. We thought that was interesting. And this is actually the first time since 2011 that we've seen any sort of insider buying in Pfizer. So that caught our attention. However, with some other facts I'm going to be sharing with you on Pfizer today, interestingly enough, and going to what Bill looks at from the data perspective, this spinoff is a rare category in the spinoff universe, and it shouldn't be ignored. And here's what I'm going to take you through as to why this is a rare case. So don't ignore the rare breakup dynamic that's at the top. So for those who don't know, my background is in mathematics, and I love the proprietary data that we produce on a yearly basis for unique pieces for us to find in some of the best opportunities out there. Otherwise, I mean, what are we? We're without any data, we're just another person with an opinion, right? So I enjoy that process here at the Edge. However, we do understand that while data isn't a prediction of future performances, the valuable data we determine gives an edge to each situation that many may have overlooked. So coming back to Pfizer, as we mentioned, it's joining a small group of rare large cap breakups. And recent spinoffs like Otis, largest player in escalators and the elevators market, that was up 42% since they spun off in April this year. This is a large cap name in the rare space, if you will. And also Carrier, because this was a three-way breakup. I mean, that's up 120%, 23% since the actual three-way split from United Technology, which subsequently they merged themselves with Raytheon to create Raytheon Technology, so RTX. Now, why is this important to Pfizer? Looking over the last 10 years of data, our spinoff data actually shows that a remarkable high percentage of S&P 500 listed companies. So looking at the parent that's post-spin, still within the S&P 500, as well as the spinoffs, they make a fair deal amount of money. And Pfizer and the spinoff Viatris falls in that category. So as these are rare events, you know, what we want to know is what does that mean for our investors? So the data shows that there's only been about 25 breakups where the spinoff was big enough to the S&P 500, and that's out of 200 names that we've looked at over the last 10 years. So meaning 12% on average of spinoffs in the US remain on the S&P 500 after the spin, or that's just about one name, new name per year for the last 10 years. So interestingly enough, 2020, I don't know if there's a indication there as why, Bill, but there are actually 3 of these transactions this year. So a little bit of anomaly. So Pfizer, Ingersoll ran early in the year, and as mentioned before, United Tech. So digging further and realizing that, looking for the different periods, we're trying to figure out what's the best time to play this situation. Is it going to be when issue trade-in? Is it going to be the first week post-spin, 1 month, 3 months, 6 months, 1 year, maybe 2 years after the spin? And we found the best opportunity to make money in this unique space is right around that 3-month post-spin. So what kind of performance do parent companies show if we were to follow this rule, this 3-month rule? Well, as you can see from the table, we found that 90% of deals actually were bought. So if you bought them at the 3-month rule and you put them in your portfolio, this is 3 months after the spinoff, and you held that for 9 months, so 1 year of listing, they made money. And you can see it there from the graph that I pulled up. And this is only left maybe a couple names that are given a negative return. However, within that data set, there's been a few cases, not a lot of cases, but a few cases where the parent company, their market size just came right down and it was reduced, and they were kicked out of the S&P 500. So they became mid-cap 400 names after being too small. So if we remove those names and we just strictly wanted to look at S&P 500 parents post-spin, actually there's a higher percentage of making money on these deals. And again, this is using the same methodology, adding the company at the 3-month mark. Likewise, only one company made a loss as a result of that. So we're getting into that higher hit rate for our clients and investors. Now, if we move over to look at spun-off companies, so we know what the parent does. What about the spin-off itself? What is their hit rate? And in this case, it's a 78% of deals made money. So it's still pretty high there. But as we can see, it's less than what the parent company's deals are making money at. So that 94% versus the 78%. However, and you can see the chart there, but however, there is a greater chance to see a spin-off company outperform the S&P 500. So it's almost like a 3 in 4 chance of finding a company outperform the rest of the market versus the parent companies, where that percentage was a little bit lower. It wasn't 74%, it was closer to 65. So therefore, with the spin-off data towards a post-spin opportunity in both the parent and the spin-off 3 months after, we think this is a good opportunity here. There is going to be a little bit of selling pressure from our analysis with regards to Viatris, because shareholders who are going to get shares of Viatris, the Pfizer shareholders who don't want exposure in this new generic pharma maker, they're gonna sell in the market, and also they're getting a small distribution of shares. It's roughly about 1-for-8 distribution. Plus the company is levered. So as a result, there is possibly an opportunity to get in at that 3-month rate. Now, what's the reason for that high hit rate and outperformance in such a large cap space? Speaking with clients and speaking with investors, we believe it's an area in the market where small, mid cap, even large cap investors don't believe they have an edge for these type of situations. Especially these mega cap situations, they believe it's well covered, so therefore they ignore them. And then likewise, because these are large cap companies remaining in the S&P index, a lot of the big institutions are automatically going to include them into their S&P 500 portfolios and the different ETFs out there. So majority of the time, these are opportunities just hiding in plain sight. And like I said, with Raytheon, that was such a large company, everyone was covering it, but you saw the returns of Carrier and Otis. Now, along with Pfizer's strong track record of Zoetis, they did that spin-off of their medicine and vaccines animals company back in 2013. That was a stellar returner for investors. So they do have a track record of getting it right. And some of the extra catalysts, any positive news that they get over this month with the late stage trial, the data on the COVID-19 vaccines, that could be a rocket fuel, if you will, for the stock price as well. There's a biopharma joint venture that there's going to look to list around Q4. It might spill over to Q1, but a neurological diseases company with Bain Capital, they have a big stake in that. And also they do have another joint venture with Glaxo as well, GSK, to create a consumer healthcare business and creating the world's largest over-the-counter business. And that may likely look to break up and list 22 or even 2023. So we see Pfizer as a medium to long-term holding, and you're going to receive a 4% dividend while you wait. So we at the Edge, we believe that there are at least 3 good reasons for investors to be confident in Pfizer going forward in 2021. And with that 3-month rule working as a better entry point, we see some upside for the company post-spin, and that upside can either increase or decrease depending on where it lists. So definitely do your due diligence on this one. If you have any questions, let us know. Now, so that's going on the spin-off side. Now, the special situation, another one of our current ideas is actually legacy motorcycle maker. Don't know if you guys have heard of this one. Harley Davidson, HOG is the ticker. Now, for this situation, there've been some recent insider buying, and that actually caught our attention, and we decided to do a little bit more work. So if I actually pull up the chart here for HOG, the insider who was buying shares in HOG was actually the new CEO who came on board, Jochen Zeitz. So he became the president, CEO, and executive chairman back in May of this year. And after being appointed, he made two open market purchases. So one, as you can see from the table here, both of them in May at around an average price of around $20 a share, spending $3 million of his own money. And then not only that, he bought again in August, and this time at spending $2 million of his own money at a much higher level, so around that $28 level. So this time, as George mentioned, insiders buying shares on the open market, especially into a price, the other way here, a price appreciation, is typically a good indication for value to be coming forward. And even more so when there are other catalysts involved. Plus, of course, his annual salary is about $2.5 million. So clearly he's not here just to pick up a check by spending 2 years worth of his salary already to increase his stake. And as for 2021, we did some work on the compensation side. 75% of his total compensation is variable. So he stands to earn a lot of money, a lot more money than what he's getting from a salary, provided a successful plan. And that plan is a new strategic turnaround plan called Rewire. So as a result of all of this happening, we decided to do a little bit more digging into this new CEO and his past track record. Now, buying into CEOs with a track record for us at the Edge has proven dividends in the past. And we're looking for, as David Marcus would say, the jockey themselves, or for us, the game-changing CEOs. And that's led us to names like Brinks in the past, the security and alarm servicing company. They appointed a new CEO at the time in 2016 called Douglas Pertz, known as the turnaround specialist, if you will, due to one of his many exploits at Recall Holdings. We covered that spinoff from Brambles in Australia. He rammed the stock price up 100% in the next couple of years post-spin. And then, of course, it was taken out by Iron Mountain. So since his appointment at the job in Brinks, if you just look at it from a 2-year waiting, we got out at the 1-year level, probably too early. But as you can see, double absolute return versus the rest of the market. Another name, Tableau Software, Data, D-A-T-A. And now this one was one of the more controversial names covered by us. And that's just due to the fact that At that time, the stock had already been beaten down 55% in 1 year. There's a lot of negatives around surrounding the sales execution, as well as the heightened competition of its cloud technology platform. And it was just a frowned on stock by investors. And I've actually had a few clients, when I called them on this, put the phone down on me because they're like, we don't want to hear about this name. But what interests us was the inclusion of a new CEO called Adam Stilipsky. So he at the time had a very strong track record for growing businesses from scratch. And AWS, Amazon Web Services, was one he grew from a pre-revenue 10-man team startup to a 10 billion first mover on the cloud computing space at the time. And we believe that with his expertise that he could come on board with Tableau, strengthen that platform. And since his appointment there, I mean, it was taken out a few years after by Salesforce, and the stock, you know, plus 300% absolute return since our analysis. And you can see a huge outperformance there. And then lastly, another name that fit that bill was Bed Bath & Beyond, the home furnishing retail company. And actually, this was presented at our last conference last year, where it was brought on as a turnaround specialist. So the new CEO coming on board, his name was Mark Trishan. He was there as turnaround specialist, as mentioned, to right the ship and help make strides to improve the digital sales of the company and help give a full turnaround plan. So 30 years track record. As you can see, he was there with Target. He has a proven record of turning companies around. He revamped the stores at Target, introduced new private labels. So all in all, this was a great making for the stock to get involved in his beliefs and what he's done. And since the conference last year, when we highlighted, it's definitely had some dips before coming back up. So maybe you made more money than us, but definitely it gave a decent return, 64% absolute return since last year's conference. And the S&P small cap index is actually down over that period. So now at Harley-Davidson, we have this guy, Mr. Zeitz. He's had a successful turnaround at Puma, actually being one of the youngest CEOs at the time back in 1993 to run a German company at the age of 30. And he's been credited for completely turning this company around, almost near bankruptcy, to a profitable company, to a well-tiered, top-tiered brands company in the sports arena. And actually, they sold themselves to Kering back in 2007. And we covered the spinoff some years later from Kering when they brought them back on the market. Oh, and the stock price, if you're looking for value, Puma jumped 4,000% since he was on board. So Mr. Zeitz is a guy we're looking at quite closely. He's also a co-founder of a nonprofit with Sir Richard Branson called the B Team. And this is looking at taking a responsible approach to businesses. So his aim is going to be making businesses sustainable. And this is what we think he can do at HOG or Harley-Davidson. So we see him as a game-changing CEO. Very similar to the CEOs we mentioned in the previous slide. But not only its strategic turnaround plan is interesting, the rewire, but management right now are under a watchful eye from an activist investor, Impala Asset Management. So they hold about a 2.5% stake in Harley-Davidson. They actually pushed for this change and demanded to be remove the previous CEO and bring on Mr. Zeitz. So they're going to be there watchfully making sure that all goes well. So all of that being said, we're drawing a lot of similarities from covering and analyzing successful turnaround stories such as Brinks, such as Tableau, such as Bed Bath & Beyond, which is still playing out in the market. And we believe that the new CEO at the helm with a track record of successful turnarounds is one thing. A detailed restructuring plan put in place for the company is a second positive step. And then the watchful eye of an investor or a shareholder presents a compelling opportunity for investors to get involved in HOG. And at the moment, we see some strong upside from current levels. And maybe they can even get this back to its glory days around 50, 60 bucks a share, which was only 3 years ago. So other stocks, so I mentioned the Spinoff, special situation, some other stocks in focus. Siemens, as our team mentioned previously in the beginning side of things, there's recently did a spinoff. There's some 30% upside on the Spinco, so a German conglomerate just recently spun off last week. Parent company is going to retain a 45% stake in the business, but Siemens has created valuable splits in the past. With Siemens Healthineers, I've mentioned earlier, they outperform the DAX index, and we do see some benefits in, like I mentioned, ENR. And also, let's not forget about Fortive. This is going through this week, this Friday, guys. So they're spinning off Vontier. This is their second split. There's no real when issue traded at the moment, but for the Rails brothers who co-founded Danaher, this is their second split of Fortive in 2 years because they have a stake in Fortive. This is their fourth breakup in the last 4 years. So they've been very busy with regards to changing the conglomerate section of the business. Now, VNT Vontier does have a bit of debt, and it will be a little bit small for the S&P 500. So there will be some initial selling pressure, but we believe that could provide a lower entry point. So with that being said, and let's not forget, I skipped too quickly. There's 5 more spins globally before the end of the year. So we're not done yet. So US names, we have about 16 spin-offs on the calendar right now. So some names, you're probably familiar with some of the names there, Pfizer being one of those 16. And then, of course, if you go on the global side, closer around 30 names, there's a greater addition of names there as well. So calendar is full. We're looking at a lot of these situations. We're presenting to them to our clients. And look, we'll look to make this presentation available afterwards. So please reach out to us. You can reach out at research@edcgroup.com if interested. As mentioned, I'm Jonathan Morgan, and I look forward to speaking with anyone who's interested in these names, as well as the upcoming situations on the calendar. But I'll hand that back over to Jim, and do stay tuned, but I appreciate the time.
Thank you, John. That was excellent. I hope you're enjoying it so far. We're nearly done. I know we've been sat here a long time. You've been sat here for a long time, but I hope you got a lot out of it. I know I've learned some stuff today, some really varied guests actually, and some different points of view. And you know, like I say, I hope you learned got some great insights. I just want to finish on a couple of things where, you know, I won't keep you too long, but a couple of things where you should be looking for. I mean, our company is about special situations. Special situations, what does that mean? There's so many things going on in the world. There's so much corporate change, and companies looking to, you know, change in a way that they think they can create value. And you know, not all of them work. You know, a lot of restructurings that we look at, you know, comes down to, you know, can actually the man in charge, can he do it? Has he a track record to do it? Can he even deliver? So as you've seen today, there's a lot of emphasis on management and quality of management, and quite frankly, there's a lot of waste out there as well. So our job is really to drill down which situations are the ones that our clients should invest in, or we recommend they should invest in, and there's 3 areas which you know, you want to look at that we've found some great success in, or you know, moreover, our clients have found great success in. And you know, one you've heard today from George Muzea's Directors Insider Dealings, and these are 3 areas where you should look for ideas, actually, ideas to start. So a good management, a good director, you know, what is his background? How much is incentivized is he in his own company? You know, does he own anything in his company? I know years ago we went to a firm, an activist firm actually, and they were sort of, you know, mulling over entering a name, and you know, we pointed out that, you know, no one had any incentives of a fallen company. And, you know, it was a bit of an eye opener as well. So, you know, people have to have incentives, and those of you who own your own businesses and 100% invested of your worth into those businesses, you're going to want to turn up for work every day, and you're going to want it to work. So there's no difference between big companies as well. But like David Marcus says, you know, the CEO, he doesn't always own the company. So you've got to look, whether, you know, he's got a vested interest in doing well, and can he even do it? So directors inside dealings is definitely a place where you should look as a hunting ground for deals. We're seeing Hog there, one of my favorites actually. You know, John and I were talking this morning where we're worried it's moving up too fast. You know, that's one where we believe that the insider's got what it takes, with a great brand name. There's a move to electrification of bikes as well. They're at the forefront of that. And, you know, the turnaround plan is starting to come through very early, though, very early. So potential decent upside there. Spin-offs, always like the idea of spin-offs and looking for places to find value. There's just natural value there. There's natural value in respect of companies breaking up, different dynamics, different new management, different metrics, all those sort of things, different indices, different shareholders, different types of companies. And that's what we try and analyze here at the Edge, whether that makes sense. Because again, you know, not all spin-offs make money. John had some statistics. We've done a 20-year study. We've done another study with the KPMG. We really rely on the facts for a lot of the basis, the start of analysis. And then we add the numbers, and then we add the directors, and then we add the technicals. And when it comes to it, you know, we've got a good situation or not, and that's what we present. So we saw that in Pfizer. Pfizer is one that, you know, I've been pushing to our clients. I think it's a sleeping giant. I think it's that, you know, environment where these things are going to wake up again. They're spinning off their generics business. There's some serious insiders with some great track records of predicting stock movements in there. You should be looking at those people. You should look at the dynamics of the spin. Companies fell out the index. I'm not sure if John mentioned, but those companies historically that fall out of big indices perform very well over the next 5 years. And that spin-off is coming up. And you know what? For such a huge company, there's Pfizer shareholders I speak to who don't even know there's a breakup coming up. So, you know, I find that worrying sometimes, and, you know, kind of pleasurable other times that we know something that someone doesn't, but a huge company like that. So they're still very undercovered situation spin-offs. And again, you know, we cover all the spin-offs around the world of a certain market size, and we pick out the good ones. So if we're looking at 60 or 70 a year, you know, you're going to get 15, 20, maybe we'll hone down on 5 to 10 of our best ones. And we've proved very valuable. We have a model portfolio that is that's consistently, you know, been up net 9% every year, but it's consistent. And you're not going to get the volatility with that, and you're on a strategy. So unless you bought into Tesla and Amazon at the beginning of the year, which of course you all did, and you're sitting on, you don't need us. But if you want a more fundamental strategy that can help your portfolio, then we got that. So I wanted to go on to the last area which you should be looking at, and it's something that we've been getting big of in the last 2-3 years now, and it's activism. And so someone says to me, well, why is activism a strategy? Well, it's a strategy because it looks, or we look at companies in the same vein as we look at spin-offs. Where's what value can be created? But it's obviously pre any sort of breakup. Now, we've had success in the past with one of the biggest ones, one of the biggest companies with AT&T. We've had recently with William Hill in the UK, and we've had a number of others across the spectrum in the last couple of years. So what we've gained on the Spinoff knowledge over the last 14 years. I've been doing this for 25 years, but the company's been going for 14. We've transferred to activism. So we are trying to spot companies out there for activists that should be targeted, that have some sort of room for improvement in margins or management or even a straight breakup. So I've got one for you today. Before I go on that, it should be on your radar as something not desperately to buy per se, because it's like a value investing stock, right? We've heard of the fact that if you go and buy cheap stock, it can stay cheap forever. So it needs some sort of catalyst, and an activist could be that catalyst. It could be the company themselves deciding they're having some sort of strategic review or something like that. But it's something that will increase your margin of safety. If you know something is, or if you know a stock is cheap or it's potentially got value hidden within it, then it's another weapon in your armory of holding a stock. So that's something you should consider. And I believe, and I said this last year, and it's happening, it's becoming more and more, and you can see more on this, because this is real uncovered hidden value. And so this should be strongly on your radar in looking at stocks. We cover these in our special situations product, and it's ones that we highlight, and a lot of these have come to fruition. There's some maybe not, but a lot of them have. So I'm quite keen on pushing that as a strategy you should be looking for. So there's always two things. I mean, obviously we do a lot of quantitative and qualitative analysis on these companies, but there's two things you should be looking for. You should be looking for one, is there maneuverable to be changed? Should get numbers add up? Is there room to change? And is there any desire to change? One of the companies we looked at previously was the Cheesecake Factory, and the Cheesecake Factory sadly had a CEO overturn who was quite stubborn. He owned a great deal of stock, and it's questionable whether we could even move that guy to even look for any change. So that again, it comes back to management again, comes back to shareholders, who they are, and can we move them, or are they open? I mean, a lot of this activism about what the guys were talking. I know David was talking more about soft activism. A lot of this hard activism just costs so much money. To fight a company costs a horrendous amount of money. So you just don't see that anymore. Rather, if there's room for change and you can spot it, maybe a suggestion to the board. So that's the sort of companies we're looking at. And they could be, value destroying again. They could be an operational improvement, so they could be a straight breakup company. So the one we're looking at today, and the one I want to highlight to you, is one which is kind of familiar, really, in the environment. And I think again, like I said before, I think the healthcare sector is coming back to life with all this stuff going on. Is Gilead. And Gilead ticker is GILD. And if you remember, Gilead's in the mix in, whether you believe there's a cure coming, whether you believe you're going to find a vaccine, whether you're going to take one, that's kind of irrelevant, but stocks move up and down on expectations. And if you remember early in the year, Gilead shares surged with the details of a leaked closely watched clinical trial of the company's antiviral drug Radicima. So it looked to be promising, but you know what? If you scratch under the surface, and at the time, we look very closely, and I look very closely. There's kind of a mess in the boardroom. The real contagion with that company is in the boardroom. It's not, it's got a fundamental good business. But what you're seeing is, people get excited, shares pop up. But if you look from that pop, which wasn't significant really, it's come right back down, and it's on its lows again. And for a huge company, it is a big company. It's around an 80 billion market cap. It's on its knees really over the last few years. Now, after the resignation of John Milligan, Gilead appointed an industry veteran who was Daniel O'Day, and he was from Roche. He came back in March 2019, and his job was to stabilize the legacy business, mobilize the balance sheet. It's got 23 billion of cash on its balance sheet, and enter into untouched markets. where it's been lagging, like oncology, inflammation, and things like that. He's got a solid background, but you know what? Some of these boards are just only as good as, you know, if the CEO's there and he's controlling the ship and he's got his board in the background, his board are just like a revolving door. I mean, they've been exiting like there's no tomorrow. So something is fundamentally wrong in that company. And we believe it should right for change. So, I mean, what we start to do when we source these companies is we look at the total shareholder return or the performance. And what we've seen in Gilead and over the last 3 years is it's not been able to beat the index performance. It's been underperforming its closest peers. The S&P's annualized total shareholder returns for the last 1, 2, 3 years have been 20, 12, 15. Gilead was managed around 3, 0, minus a half, respectively, for the same comparable periods. So this company is major underperforming and it's right for change. Now, why is it right for change? And what do we see in there? We see two businesses. It has hepatitis C virus business and as an HIV business, which we believe could be separated, and we want it to be separated, and we want it to be separated to achieve shareholder value, high multiples, and get a focused management. We believe Gilead has lost its way, and we're calling for that to change around. Excuse me. So Gilead hit a last time high in 2015 when it peaked to 108. I think it's around $64 today. And its HCV franchise drugs will perform exceedingly well. So this company, for one, I suppose the management really, again, brings back to the management, has been driving the share price into the ground, to be fair. And, you know, I believe that their shout about finding a drug early in the year was a little bit, what should we say, fluffy to hold the stock up. So we don't buy into that too much. Look, there's a hidden catalyst. Maybe they do find something. Maybe something works. I don't know. We don't bank on that. What we see is what we got in front of us. So we believe the separation of the HVG franchise via a spin-off will not only help discover value for the cash generating HCV business, but it also unlock value for the HIV business, which seems underappreciated by the market. So you've got two businesses there, and we essentially see at least 40% upside on that. So at its basic level, so what's interesting, again, what's interesting about the and why should you care? We've done some extensive analysis on this. It's available to you if you want to check in, or we'll send it to you and you can see, do your own due diligence as ever. But we got a good idea of where this thing should be and where it is now. And at its most basic level, it's undervalued in comparison into its other biotech peers. Peers average multiple trading EV to EBITDA around 11.5. Gilead is trading around a 7. We got a 1 year forward EV to EBITDA multiple discount of around 37%, and so it's extremely undervalued in our view. So we got one, it's undervalued. We got two separate businesses moving at different paces, and one of their cash generating portfolio, the HCV franchise, is struggling with increased competition. But it does have good cash flow. So there's a business there that needs to be spun off and separated. It needs to have some real focused management. But we believe if that happens, then these two businesses will fly. And lastly, it's got some mature products which are kind of which have concerns, but we believe are overstated as well. So all in all, we got 3 areas which we believe there's some room for change, and we're calling for a separation of those two businesses. It's going to take someone quite large to do this. Obviously, it's 80 billion market cap company, but we believe the split is ripe. So that's one that we wanted to highlight to you today, and gives you an insight in how we look at the world in terms of value creation. So there's a huge company there. It's probably well known. It's in the news, but it's actually destroying shareholder value. So that's the one we want to highlight. We've done these big, we've done these small, we've done these mid cap. And given all the above points, and again, check in for the analysis, we believe Gilead should explore strategic alternatives for the business. And again, we believe there's about a 40% upside. So let's, like I say, I want to keep that short and sweet for you today. I hope you enjoyed everything we've said. Please check in, email us. We've recorded everything. We'll send out the recording. Please check in if you want that. And I'm just very, very happy that you've come, you've joined, contributed. We've raised over $6,000 for a great charity, and I'm really so pleased and proud. Yeah, just to check in and let us know what you think of what we did today. It's our first time. I know there's a few technical difficulties at the beginning, bit of a nightmare, but I think we settled after a while. And thanks to you, Paul, for moving that along.
Thank you, Jim. I thought it was great, and we're raising money for an amazing cause.
Thank you, man. All right, great. Well, listen, we're going to end it there, Paul. If you have anything else to say, or that's great.
It's good. It's a wrap.
All right, guys. Thank you very much. Do check in. I hope you enjoyed today. Thank you. Bye-bye.